Here's the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
You should never invest in something that can't be simplistically explained to you. The very, very good investment advisors can take complex matters and make them very simple.
Have earned and deserved another term as chair of the Federal Reserve. You have proven to be a steady hand throughout this pandemic, our ongoing recovery.
I join the ranking member's view that you have earned another term.
Republican Congressman Patrick McHenry there and Andy Barr telling Fed Chair Jay Powell they support his renomination. The Fed Chair facing his second day of gritting on Capitol Hill. We'll bring you the Q&A as soon as that begins. I want to bring in the Bloomberg team now. Joining us now with a preview, Anne-Marie Hordan down in Washington and Michael McKee as well. And Anne-Marie, let's begin with you. Right there, a second term for the Federal Reserve Chair. Seemingly a little bit of Republican support. Does he have the support of this White House?
Well, that is the big question, John. And there also was a Democrat, the Representative Brad Sherman from California, also saying he does think Fed Chair Jay Powell should get a second term. The question in Washington is, what is the signal from the White House? And so far, it has been mute. Many people think potentially this White House would go back to that long tradition that we've seen for decades, that you continue with the Fed chair to continue policy and to not meddle in politics of monetary policy in the Federal Reserve. But of course, we did see President Donald Trump break that mold when it came to chair, then Janet Yellen, Federal Reserve chair, when he decided to go with Jay Powell. Now, the question is, what does the White House do? And we just don't have a signal yet.
Mike McKee, your take on that subject, an important topic for that matter.
Well, it's really a political question. It's not a question of his competence for the job. Jay Powell, by all measures, has done a very good job as the Fed chair and learned as he's gone along. There's pressure on Joe Biden to put in a Democrat, a more liberal-thinking Democrat along the lines of the kind of people the progressives want throughout the Biden administration so that they can keep the pressure on to keep interest rates low. And so would he dump Jay Powell for a minority or a woman? It's a possibility. It's a political possibility. But when you think about the effect on markets and when you think about the impact overall on the Fed, there doesn't seem to be a reason for Powell to go.
The Federal Reserve Chairman, with his opening statement right now, this opening testimony about halfway through. After that concludes, I'll get you the Q&A in just a moment. Mike, for the Federal Reserve Chair, it's not just about him, it's about the Vice Chair. There's a spot there on the board as well, another governor perhaps, and we've been talking about this for a while. It always felt primed for Governor Brainerd to take the top spot if you had a Democrat back in the White House. Is that part of the conversation still?
Well, it's part of the background hum. Whether or not they're thinking of that, it would only complicate matters in the sense that then they've got another seat to fill, because by tradition, if a Fed chairman is not reappointed as chair, they tend to resign as a Fed governor. So Jay Powell would leave, and that would be another seat open. There's one open now. And then the vice chairs, as you mentioned, Richard Clarida's term is up as vice chair. No word on whether he will be reappointed. And Randy Quarles, who's the vice chair for supervision but has a vote on the Open Market Committee, his term runs out this fall, and Democrats in the Senate have made it clear that they have no intention of confirming him to a new term if he were reappointed. The only question is his term on the Fed as a governor runs for another 12 years, so he could stay around if he wants to. That's only happened once in the Fed's history, but it is a possibility.
Mike, on that point, that's the point I want to build on and finish on with you, Anne-Marie. It's often overlooked over on the monetary policy side of things. The Fed also has a mandate to take care of financial stability to some degree with regulation. And Anne-Marie, I do wonder if that's something that there is a frustration amongst Democrats, particularly Senator Warren, and perhaps this is where they could really reshape this Federal Reserve.
Yeah, potentially. And what Mike McKee there is talking about, these other board seats, this is potentially where you could see the administration take an approach. We're going to continue that tradition to keep the Fed chair ongoing with the previous administration, but maybe we can get some of the more people and a nod to the progressives left, like Senator Elizabeth Warren, as you mentioned, some of these others to support him. That could potentially be a compromise. We do know people close to the matter are telling our team here in Washington that this White House is not looking at this incident in terms of the Fed chair in a singularity. They're looking at it in all-encompassing. So maybe it's potentially keeping Jay Powell, but mixing some of the others that support him. It's going to be very interesting. But the bottom line, John, is that we have not heard directly from the White House at all about this. And this is where it lies. It lies with the president and his advisors, and we've just yet not heard what he was going to do in February when it comes up.
The Federal Reserve Chairman, Jay Powell, in front of the Senate Banking Committee today, just wrapping up his opening testimony. The questioning is just about to start. Bloomberg's Anne-Marie Hordern and Michael McKee with our Bloomberg team wrap of what you can expect from the chairman today in front of the Senate Banking Committee. Joanne Finney, just quickly before we turn to that Q&A, I want to understand from your perspective what you're looking for from an event like today as someone who looks at single names in this equity market.
Well, John, you know, the chair is obviously going to speak to the banking stability, their dual mandate. They've continued to emphasize, right, that their mission right now, given how low inflation is, even with this transitory spike, that they have a lot more room to keep monetary policy very accommodative. And that's, I think, going to further help the reopening. And so when you think about names to invest in, given that that's the underlying shape of monetary policy, you can have a lot of confidence that labor markets are going to recover. You know, as I said, again, after Labor Day, we're going to get more people back to the workforce. So when you look about the investing environment, you have to think about the consumer spending angle. So as I said, TJ Maxx, you know, General Motors, any kind of consumer oriented, but that also includes technology, right? Back to school, PCs. So when we look at particular investments to make in this kind of environment, we are, you know, acknowledging that monetary policy is going to remain very accommodative. Plus, it looks like we're going to have additional fiscal policy stimulus coming along as we go through the summer. We should get more information about that. And that's also positive, you know, for longer term economic growth, potentially, if these are productive investments. And that's also a positive environment for equity markets.
Joanne Feeney, it's good to have you on the show. We've got to get you back soon. Let's head down to Capitol Hill and catch up with the Federal Reserve Chairman facing questions from the Senate Banking Committee today. Let's take a listen.
We could make the economy safer and fairer with higher capital requirements of the biggest banks. My question, Mr. Chair, is why? Why have you been against stronger capital requirements and using the countercyclical capital buffer in curbing runaway executive bonuses and stock buybacks?
So I guess I would say with the stress tests, the severity of the stress tests has very much been maintained. The effect of the stress capital buffer overall was to raise capital requirements for the largest firms. And they did manage to get through the recent pandemic and the acute phase of it and the recovery, and did their jobs during so I think that our by and large our financial institutions are well capitalized. We limited their distributions during the pandemic, and their capital levels actually rose quite materially during the course of the pandemic. So the financial system is strong and the banks are strong. I have felt, and I've said on a number of occasions, that the level of loss-absorbing capital in the system is about right. I think the experience of the pandemic bears that out. I would be prepared to deploy the countercyclical capital buffer if I thought that the conditions we laid out were triggered, but I haven't so far felt that way.
Every time the Fed is, thank you for that answer, every time the Fed's taken action to lower capital standards, it claims that doing so would increase lending in the economy and otherwise promote economic growth. That hasn't been what's happened. Instead, buybacks, dividends, executive compensation have continued to go up even during the pandemic. We empower workers by maintaining tight labor markets and strong financial regulations. I believe strong financial regulation enables the Fed to be more aggressive in helping workers, and that should be your mission. It's time, Mr. Chair, respectfully, you changed the way you think about regulating the biggest banks. One other question, Mr. Chair. In addition to adopting pro-worker financial stability policies, the Fed can further help communities of color by leading the push for a strong update to the Community Reinvestment Act. We've seen some good developments there with a different controller of the currency. Last year, the Fed unanimously released a framework for modernizing CRA that was well received by representatives of the civil rights community and by banks. My question, Mr. Chair, is the Federal Reserve still committed to full, not piecemeal, full CRA modernization with an interagency approach, and what is the timing?
We're very much committed to that outcome, and I actually feel good about where we are on this. We're resuming our interagency discussions on it, and I'm optimistic that we'll come out with something that has broad support among the community of intended beneficiaries, and by the way, also among the financial institutions, and that it will be a good, solid updating after many years into the more technologically enabled era that will help the intended beneficiaries quite a bit.
And the timing, Mr. Chair?
Working on it now. I think you'll see we're reacting to a very large, analyzing and reacting to a very large quantity of comments and discussing that with particularly with the OCC, but also the FDIC. It's not clear what their role will be at this time, but we hope they'll join in. I think we'll be making visible progress in coming months. I can't give you a finish date yet, but I think we're moving now.
Okay, thank you. We will be watching. Senator Toomey.
Thank you, Mr. Chairman. Chairman Powell, in your testimony, you said that substantial further progress is still a ways off for the economic recovery, and I think you cite that as a justification for the extremely accommodative policy that you have. I don't think you're referring to the need for substantial further progress in GDP growth. I think it's employment that you're thinking of. The unemployment rate has declined dramatically, but it hasn't reached the pre-pandemic lows. And I think you've also made references to the workforce participation rate. I guess my question is, isn't it entirely possible that for a variety of factors, not the least of which is legislation that we've passed, the labor force participation rate may not get back to the record highs that we recently saw, and we've made it more difficult for the unemployment rate to get back to the record lows that we were at before? And do you take that into account when you determine how much progress we've made towards full employment?
So what was happening toward the end of the very longest expansion, was that people were staying in the labor force later into their careers, and so labor force participation consistently remained above all estimates of where it was going to be. Then what happened in the pandemic was a lot of those people retired, so there have been really significant amounts of retirement. So the truth is, we don't know where that's going to settle out, and it'll take a period of years for us to really understand what the new trend is. I don't see that as a problem for the standard we've set forth for tapering asset purchases, which is substantial further progress. We're not going to need to know the answers to those questions to make a decision that we've made substantial further progress. It will be more of a consideration for raising rates where we've set a higher bar.
Okay, I just hope there's a focus on the distinct possibility that we're just not going to get to those levels anytime soon. Let me turn to housing prices a bit. The Case-Shiller Home Price Index showed housing prices across the U.S. as a whole increased in May by more than 15% from the previous year, and that wasn't a base effect. There was no big decline in May of last year. 15% clearly is making housing less affordable, more out of reach for more people. So a number of voices within the Fed seem to be increasingly concerned about this. The St. Louis Fed President James Bullard said just this week that he is, quote, a little bit concerned that we're feeding into an incipient housing bubble, end quote. Dallas Fed President Robert Kaplan said that the Fed should begin tapering to begin offsetting, quote, some of these excesses and imbalances, end quote. The Boston Fed President Eric Rosengren raised alarms that the Fed's mortgage-backed security purchases may be contributing to the current boom in real estate prices, citing the potential financial stability implications. I guess, you know, I've been clear for a long time, I've been very skeptical about the ongoing mortgage-backed purchases. Are you at all concerned about the unintended consequences that are associated with $40 billion worth of mortgage-backed security purchases that continue month after month?
So housing prices are going up, as you mentioned, around 15%. This is a very high rate of increase. A number of factors are contributing. Monetary policy is certainly one of those factors. There are also other factors. People have very strong balance sheets, so they're able to make down payments. There are also supply factors that are constraining the supply, at least temporarily. So, you know, my best thinking is that the difference between Treasury purchases and MBS purchases for this purpose is not a large one. Probably MBS purchases are somewhat more supportive of housing. That's not their intent, but that may be the effect. Really, the larger point is that monetary policy is supporting this, and that is something, that's a discussion we're going to be having on an ongoing basis. We talked about some of these things at our last meeting, and we'll talk about it at the next meeting in a couple of weeks.
I think that's important. Let me close with a question on a central bank digital currency. During your testimony yesterday, I sensed what I wasn't sure but thought might be a change in your tone about the virtues of a central bank digital currency being issued by the Fed. One of the things you said yesterday is that one of the stronger arguments in favor of a CBDC is that, quote, you wouldn't need stable coins, you wouldn't need cryptocurrencies if you had a digital U.S. currency. Of course, isn't the reverse also true? If you have stable coins, cryptocurrencies in use, then maybe there's no need for a central bank digital currency. I guess my 2 points. One is, it's my view that the development of a central bank digital currency by the Fed would require congressional authorization. I'm wondering if you share that view. And secondly, it is still not clear to me what problem a central bank digital currency would solve. And I wonder if you think there are problems that only a central bank digital currency can solve.
So first, I'm legitimately undecided on whether the benefits outweigh the costs or vice versa on a CBDC. Yesterday, I was answering a direct question about a particular argument. I said, in favor, that would be one of the stronger arguments. Okay. I would agree that the more direct route would be to appropriately regulate stable coins, which we don't do right now, and that's going to be a very important thing that we do. So in terms of congressional authorization, you know, there are different views on that. I've said publicly, and I think this is right, that we would want very broad support in society and in Congress, and ideally that would take the form of authorizing legislation as opposed to a very careful reading of ambiguous law to support this. It's a very, very important initiative, and I do think we should ideally get authorization. In terms of what the problem is to solve, I think that is exactly the right question, and you know, I think our obligation is to explore both the technology and the policy issues over the next couple of years. That's what we're going to do so that we're in a position to make an informed recommendation. But my mind is open on this, and I honestly don't have a preconceived answer to these questions.
Thank you, Mr. Chairman.
Senator Menendez of New Jersey is recognized.
Chairman Powell, as the Federal Reserve seeks to fulfill its mandate of maximum employment, I want to discuss with you the tremendous impact that immigration has on the labor force. Isn't it true that over the past 10 years, the immigrant labor force participation rate has been consistently higher than that of native-born workers?
I believe that's right.
Yeah, and let me help you verify that. The St. Louis Fed noted in their study that as of June 2021, the foreign-born labor force participation rate is 3% higher than the native-born rate, and that gap hasn't ever been lower than nearly 2% for the past 10 years. And an important but often overlooked characteristic of these immigrants is their youth. According to the Bureau of Labor Statistics, 71.8% of foreign-born workers are between 25 and 54 years of age, compared to 62.2% of the native labor force. So as the American labor force ages, will immigrants, and therefore immigration policy, play an increasingly important role in maintaining a healthy U.S. labor force, therefore a healthy economy?
So, Senator, I'm going to stay away from making any recommendations on immigration policy. It's not in our wheelhouse. I will say that labor force growth is one of the two things that can drive the top line, the other being productivity growth. And, you know, in recent years, immigration has been a significant part of, accounted for a significant part of growth in the workforce.
Well, I appreciate that. I'm not asking you about immigration policy. What I am saying is that one of the newest studies shows that nearly 1 in 4 Americans is projected to be 65 years of age or older by 2060. So while America gets older, the overall population is growing at a slower rate than it has in almost a century, leaving unfilled job openings in a future American economy. And I think we should be looking at our immigration policy, whatever that might ultimately be. I have my own idea, the U.S. Citizenship Act, as a source of dealing with the labor market. Now, let me continue on the question of the labor market. One part of the Fed's dual mandate is to maximize employment and understanding what factors inhibited people's ability to work as a key to helping achieve that goal. On page 7 of your monetary policy report, and I'll quote directly from it, the effect of the pandemic on employment was largest for workers with lower wages, for workers with lower educational attainment, and for African Americans and Hispanics. And these hard-hit groups still have the most ground left to regain. And the pandemic seems to have taken a particularly large toll on the labor force participation of mothers, especially Hispanic mothers. That's very much true. So have disruptions in childcare due to the pandemic had a negative effect on employment?
Yes, they have, and also schools being closed. Caretakers generally are having a hard time getting back into the labor force for that reason.
The Federal Reserve's data shows that the pandemic's effect on childcare caused 9% of all parents to be unable to work late last year, and an additional 14% of parents had to decrease their hours, and this effect was especially pronounced among Black, Hispanic, and low-income households. So is the effect on child care on employment isolated only to the COVID pandemic?
Sorry.
Is the effect of the availability of child care that is affordable on employment isolated only to the COVID-19 pandemic?
I'm going to guess, really, that the answer to that would be no.
Yeah, and it is no. Studies have shown that working families pay for child care ending up 35% of their income on average, 5 times more than what the Department of Health considers affordable. So it seems to me that increasing the availability of high-quality, affordable child care, like what President Biden proposes in the American Families Plan, has a positive effect on employment, enables businesses to more easily find qualified workers, and ultimately helps address supply bottlenecks. The same Fed study I just cited notes that reducing or offsetting the cost of child care has a particularly strong employment effect on Black, Hispanic, and low-income families. The pandemic showed all of the inequalities in our nation, highlighted in a way so dramatically, and particularly communities of color. Now, the employment challenges, we all talk about wanting to get people to work, the employment challenges that people have in being able to work, and they, as I have shown in the Fed's, St. Louis Fed statistics, more gainfully employed than native-born. It seems to me we should be working on making the pathway easier so that businesses can have qualified workers. Thank you, Mr. Chairman.
Senator Rounds of South Dakota is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, once again, it's good to see you, sir, and I have most certainly appreciated the time that you spent trying to not only educate us, but also to work with us. I understand that clearly you've made it your mission to adhere to the guidance for the Fed in which you work to maintaining 2% inflation over a period of time, as well as full unemployment or full employment. And when we talk about it, it's always a combination of which one you're more focused on and how you maintain that, while at the same time responding appropriately in a non-political way to the actions of Congress and the administration. I'm just curious, with regard to today's position, we're coming out of a pandemic. We've put a lot of fuel into the economy with direct payments and so forth, and people are trying to get back to work right now. And yet we've got inflation, which right now in this current state seems to be above a 2% rate. Can you talk a little bit about the measurement time period that you believe is appropriate for shooting for a 2% goal? And if there is a concern that you would express or that you follow up with when we talk about overinflating or perhaps putting fuel in, what concerns you would have and how you would respond to congressional activity?
So the inflation that we have today, what we said is that if inflation runs below 2% for an extended period, we want inflation to run moderately above 2% for some time. This is not moderately above 2% by any stretch. This is well above 2%, and we understand that. And it's also not tied to, the things that inflation is usually tied to, which is a tight labor market, a tight economy, that kind of thing. This is a shock going through the system associated with reopening of the economy, and it's driven inflation well above 2%. And, of course, we're not comfortable with that. In terms of the test that we articulated, we said we wanted inflation to average 2% over time. We didn't tie ourselves to a formula. What we really want is inflation expectations to be anchored at 2%, because if they're not, there's not much reason to think that inflation will average 2%. So that's really how we're thinking about it. What's the challenge we're confronting is how to react to this inflation, which is larger than we had expected or than anybody had expected. And to the extent it is temporary, then it wouldn't be appropriate to react to it. But to the extent it gets longer and longer, we'll have to continue to reevaluate the risks that it would affect inflation expectations and will be of a longer duration. And that's what we're monitoring.
You've been very careful, and I've appreciated the fact that you have done your best to be apolitical in this regard. And yet, at the same time, we're going to have a debate about whether or not we need to add additional fuel to the economy in terms of additional payments to individuals. And as we make that discussion, recognizing that you're going to do your best to be apolitical and simply to respond based upon your goals of the long-term goal of 2% inflation and full employment, how do you see this right now with inflation right now being the focal point, and yet the possibilities of more dollars being put into this economy in this recovery stage? What concern would you express, if any? And I know that your job is not to give us advice, but rather to respond to. What are the tools available for you to try to maintain that long-term goal of 2% during a time in which Congress may very well be adding additional fuel to the fire, so to speak, for inflation?
So the way it works is we watch what Congress is talking about, and then ultimately, and there reaches a point at which our staff will say that looks like it's got a good chance of happening, and then we'll put something into the staff will put something into the forecast, and all of us will make our own judgment about whether that was the right thing to do, whether it's too big or too small. And we never then take that into the public sphere and say, please don't do that for this reason or that reason. It's really not up to us to play a role, as you know.
But the tool that you would use would be within monetary policy of the price of money.
Always, the tools we have are, in monetary policy is to raise interest rates, to tighten financial conditions more broadly, to slow demand down, And that's how you get control of inflation, and that's what you do. At a time like this, though, policy is so accommodative. You know, it'll still be accommodative after we slow asset purchases, ultimately stop them, and then raise interest rates. It'll be accommodative for quite a while, but that's what we do, and that's what we will do when and as we need to. In the meantime, we're trying to understand this particular inflation is just unique in history. We don't have another example of the last time we reopened a $20 trillion economy with lots of fiscal and monetary support. We don't, so we're just trying to be, we're humble about what we understand, but we're trying to both understand the base case and also the risks.
Mr. Chairman, thank you very much for your response. And Mr. Chairman, thank you.
Senator Rounds. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. And Chairman Powell, it's great to see you. Thank you for your good work. You know, one of the issues that you and I spent a lot of time talking about over the last year plus has been, access to capital issues. And as we know, COVID disproportionately hit communities of color. We lost 440,000 Black-owned businesses last year. And as we've discussed in the past, I've been a big advocate with many on this committee on both sides of the aisle to promote investment into minority depository institutions, into community development financial institutions, and actually working with former Secretary Mnuchin, we got $12 billion into the relief package back in December. Some of that will go into, as you know, Tier 1 capital into the CDFIs, which could actually increase their lending capacity by about 50%. But getting that access to capital to low and moderate income communities is really, really important. Is there more that the Fed can do? Let me give you a two-part question. The Fed can do to support CDFIs, and is there anything similar to programs like the Fed's Paycheck PPP program liquidity facility, which could also potentially be used? I know, again, we've discussed some of these things, but I'd like to see if what your current thinking has been on this issue.
So we do see, and we saw particularly during the pandemic, the good that CDFIs and also minority depository institutions can do and we're doing. And we try to provide whatever resources we can, and a lot of it is just engagement and things like that, and also including the CDFIs in the PPP liquidity fund, and doing everything we could to incorporate them in a way that was useful to them. So all of those things are good. I think if we could think of more things to do within our mandate, given our authorities, we would do them, because we do see the good that they do in reaching communities that are not necessarily reached by other banks.
And I do hope, beyond CRA, that we can, look at, I've got a lot of community banks as well that want to try to get into this market, and got some ideas I'd like to come back to you and the Fed on, because I think sometimes there's a feeling that there's not enough regulatory discretion if they want to kind of lean into lending into low and moderate income communities. I wanted to raise one other issue. I think we all know housing prices are up dramatically. Matter of fact, the Federal Housing Finance Agency's House Price Index showed that house prices were up 13.9% over the 12 months ending in March 2021. I know a lot of discussion around inflation here. Obviously, if the housing market is overheated, that poses a huge issue. Is there, how overheated do you think the housing market is at this point? And what kind of tools do you have that could help deal with that problem?
Price increases are very strong in housing, and it's right across the country, and we see that, we hear that everywhere. And there, as I mentioned, there are a number of factors at work there, both demand and supply. There's a lot of demand because household balance sheets are just in the aggregate, it's very strong shape. Monetary policy is clearly supportive of people who want to get mortgages now, although most of the people getting the mortgages have very high credit ratings. It's very different than it was before the global financial crisis. There are also, both their supply constraints and this predates the pandemic, and this problem is still going to be there when every other problem is solved, which is difficulty in getting zoning, in getting trained workers, the raw material shortages and high prices and bottlenecks will probably abate over time. But it's not. I've heard from many of you that this was a problem before the pandemic, and I think that's probably going to remain the case.
Well, I agree. I think the supply issue is something we have to address, and Chairman Brown has been working on this. I've been working on some ideas. I also think one of the things we've got to grapple with, if we go back again to the kind of wealth gap issues, particularly racial wealth gap, 10-to-1 black versus white families, a lot that goes to home ownership. But I think it's also a challenge not only for black families, but for first-generation home buyers anywhere. I've been working on an idea that somebody else brought to me that would say, can we, in effect, using Ginnie Mae with a slight interest rate subsidy, almost provide for the same payment you would have on a 30-year mortgage, a 20-year mortgage product. And we've called it the Lift Up program, and I think my time's expired, but I'd love to share more of that with you, and as I'll share with my colleagues. Thank you, Mr. Chairman.
Thanks, Senator Warner. Senator Kennedy from Louisiana is recognized for 5 minutes.
Mr. Chairman, I want to begin by thanking you once again and your colleagues, some of whom are sitting behind you. We all remember well spring of 2020 when the world economy almost melted down. It didn't in substantial part because of the actions that you and your colleagues took. You kept this thing in the middle of the road. Now, some days you had to do it with spit and happy thoughts, but you kept it in the middle of the road. I remember particularly your currency swap lines. You didn't read a lot about it, but I can understand when the world's melting down if other countries seek out treasuries, but when they don't like treasuries, they want hard, cold American dollars. That's scary. So I want to thank you. This is my question. We have spent, not just during the Biden administration, but during President Trump's administration, we have spent an enormous amount of money. I mean, it's breathtaking. And now some agree with it, some disagree with it, but some say you shouldn't have done it. Some say we had to do it. It's probably a little bit of both. A lot of it wasn't paid for. And I look around, and President Biden is asking us in the next, 6 months to spend, another $5.5 trillion. And there's a lot of talk about pay-fors, but it won't all be paid for. We know that. At what point do these deficits matter? Are we living in a different world? I mean, I know you'll probably say, well, deficits always matter, but at what point does the marginal benefit of the extra deficit spending become less than the marginal cost?
I don't think there's a precise point that I can identify. I will say that we're not on a sustainable path. We actually haven't been for a long time. That just meaning that the debt is growing substantially faster than the economy, and in the long run, that is not sustainable. We're going to need to, that the laws of gravity have not been repealed. We will need to get back on a sustainable path at some point. I think the time to do that is when the economy is strong, unemployment is low, taxes are rolling in. That's the time to do it, and to do it with a longer-term plan that matches up our spending needs and our revenues. That's what we're going to need to do. We will eventually have to do that.
When do you think that will be?
I wish I knew. I mean, I would say, the dollar is the world's reserve currency. People are buying our paper around the world. I don't think there's, any issue of being able to fund our deficits in the near term and the medium term. There's no evidence that there is, but, we shouldn't wait until the urgent need arises.
Yeah, it's too late then. Well, I mean, everybody seems to be a Keynesian now, and that's fair. Dr. Keynes was brilliant, but some people forget about that chapter in one of his books where he said, okay, you deficit spend and you borrow to stimulate your economy, but when it's better, you pay it back. He said that very clearly. You pay it back. The other thing that none of us wants inflation. But it's not just inflation, as you know much better than I do. It's inflation expectations. And I worry that if we spend this extra $6 trillion or $5.5 trillion that President Biden wants to spend, that the private sector is going to say, we're going to have more inflation. I don't care what they say at the Fed. We're going to have more inflation, and we're going to start raising prices. I mean, you don't have to be Einstein's cousin to figure that out. Don't you think that's something we have to consider?
Well, I would agree with you that inflation expectations are really central to what we think are central to what creates actual inflation. We see them now being, they've moved up. They moved down at the beginning of the pandemic. They've moved back up roughly to where they've been in recent years, so they're not at a troubling level. Okay. But it's something we'll be carefully watching.
All right. Last point, I'm not expecting a response. Resist the pressure. You're going to be asked by a lot of people to get involved in social policy, in cultural matters, and in what some will call economic policy that really has nothing to do with the Fed's mission. And it's not just happening here, it's happening all over the world. Don't let us become Turkey, where the whole central banking system is politicized. Please resist it. Thank you, Mr. Chairman.
Thank you, Senator Kennedy. Senator Smith from Minnesota is recognized for 5 minutes.
Thank you, Chair Brown and Ranking Member Toomey, and thanks so much, Chair Powell, for being with us. I appreciated the chance to have a longer conversation with you earlier this week. I want to try to touch on two issues that are important to me. The first is just following up briefly on Senator Brown's questions around the Community Reinvestment Act, and then I want to go to the systemic risk that climate change poses. So earlier this week, you and I had a chance to talk about this, and I see the Community Reinvestment Act as the main rules that govern how banks provide services in low and moderate income communities and communities of color, which have experienced a systemic and severe lack of access to capital and lending and financial services due to discrimination. I'm glad to hear you think that you'll be seeing some updates in the coming months, and I wonder if you could just tell us a little bit more about what the Fed has learned from all the comments that you've received from the CRA proposal that you released last year.
So quite voluminous comments, as you can imagine, from all corners, and I think we're learning a lot, and we're going to incorporate improvements. But broadly speaking, this proposal, this approach, has the support of the intended beneficiary community, and also, to a significant extent, the support of the banks who want, they want CRA to be effective. They want it to be well measured. They're committed to having it being an effective program, so I believe. And so generally, we're in the middle of setting up to try to write something that reflects those, the appropriate comments, and then we'll publish that again. But it'll take some time, and we do hope to get all of the banking agencies on board for that. So as I mentioned, I'm optimistic that this is going to a pretty good place.
That's great. I'm glad to hear that. I think that a well-functioning and modernized CRA is just absolutely crucial to making sure that all sectors of our economy, for all people, are growing and working. And as Senator Brown says, that we fulfill that promise that we all do better when we all do better, which I think is at the heart of the CRA. So thank you. Let me just move to this question of the risks posed by climate change. Yesterday in your testimony before the House, you indicated that the Fed is in the beginning stages of working on a program that will engage with financial institutions on climate risk. And the last time you came before the committee, you said that you believed it was important longer term for firms to publicly disclose their climate-related risks. And since then, the SEC has received hundreds of comments. Vice Chair Quarles has highlighted the importance of climate risk disclosure, and I believe SEC Chair Gensler has signaled his intention to begin rulemaking around climate disclosure. So Can you comment on how you see the role of the Fed on climate risk disclosure for financial institutions?
I guess I'd start by saying that really the foundations of all of this are that we need to get good data on the implications of climate change and how to think about that in terms of the risks that the financial institutions and other parts of the economy are running. And so that's a very basic exercise, and we don't have that yet. Once you have the data, then disclosure is going to be important because markets are going to work. Markets are going to be very, very important, and the world investor community will be very interested in this. So those two things, and those are, the Fed can help with research and data collection, things like that. The disclosure issues are really squarely in the province of the SEC, and I know they're working very hard on those. And around the world, there's a lot of progress and focus on these things, and I just think they're quite central to anything that we are ultimately able to accomplish here.
So I think it's fair to say that the European central banks have led the way here. What can we learn from the approach that they've taken?
I think one thing I would point to is the climate stress scenarios that have been developed by the Network for Greening the Financial System, and a number of the major European central banks are running climate stress scenarios, very distinct from stress tests. And what they're really trying to do is with financial institutions, look at what the effect over a long period of time on their business and on their business model could be from reasonably plausible climate outcomes for the evolving climate. And it's proving to be, I think, a very profitable exercise both for the financial institutions and for regulators. So that's one thing. Now, we haven't decided to do that yet. We're in the process of looking very carefully at that. My guess is that's a direction we'll go in that we're not ready to do yet.
Thank you. Mr. Chair, I realize I'm out of time. I want to just note that I think that some would say that climate risk is a political issue. I see it as a systemic financial risk, just like other systemic financial risks that big banks and small, medium-sized banks have to address. So I think that it's extremely important. I urge the Fed to continue to look at these impacts and to move with alacrity because I think, as you say, Chair Powell, I believe that the markets are looking for clarity about how to measure and how to assess these risks for the good of investors and for everybody. Thank you.
Thanks, Senator Smith. Senator Haggerty of Tennessee is recognized for 5 minutes.
Thank you, Chairman Brown and Ranking Member Toomey. I appreciate your holding this important hearing that has to do with our critical job of overseeing the Federal Reserve. And Chair Powell, I want to thank you for being here with us again. Today, I'd like to talk with you about inflation. Inflation is the insidious tax that the Biden administration is imposing on everyday working people here in America right now, and it's of great concern. Back in February, I discussed with you about how the U.S. economy at that point was forecast to see 6% growth this year. And at that point, I expressed serious concerns about the Democrats' nearly $2 trillion of additional partisan spending on an economy that was already recovering very rapidly, thanks to the effects of Operation Warp Speed, and also thanks to the policies that have been in place during the previous 4 years that have put our nation on a solid footing in terms of tax cuts, fair and reciprocal trade, and deregulation. The Federal Reserve's challenging and dual mandate is to realize price stability and maximum employment. But runaway Democrat spending and policies that they are imposing are making your job harder than it already is. The bill that Democrats rammed through in March spent roughly 10% of our GDP. And now they're looking to spend maybe another 20% of U.S. GDP on a purely partisan basis. They're throwing around trillions of dollars like it was simply monopoly money. When really what it's doing is taxing Americans' hard-earned paychecks. It's very irresponsible. It's creating inflation outcomes that many of us haven't seen in our adult lifetime, certainly not since Jimmy Carter was president. Echoing what Ranking Member Toomey has said, the concerns that he's raised about inflation, I worry too that things may spiral out of control if we don't show some restraint. At the same time, President Biden and the Democrats are imposing policies that work against maximum employment. They're giving away employment incentives. They're raising taxes on job creators, throwing away our energy independence, and freezing American investment. The Fed has more direct control over inflation and price stability than it does over employment. Businesses create jobs, and price stability allows American businesses and families to make business decisions and to plan their everyday finances. But now, Americans have a sense of scarcity, and I believe a sense of panic over inflation. The policies that are being imposed are causing families in my home state of Tennessee and all across America to make financial decisions with soaring inflation in mind. Price stability is not a 12% annualized inflation jump like the one we just saw from May to June. People in Tennessee are seeing their buying power eroded like never before, and they don't see this as transitory. And I'm sure people in Chairman Brown's home state of Ohio and Ranking Member Toomey's home state of Pennsylvania are feeling exactly the same way. As you know, inflation expectations can be self-fulfilling. Inflation and price instability at this level is bad for America. Chairman Powell, this environment suggests to me that the emergency posture that I understand the Fed adopted back during the depths of the pandemic seriously needs to be reconsidered right now. And I'm very worried that the Fed's continued level of asset purchases and balance sheet expansion is facilitating this runaway spending that the Democrats are imposing upon us and adding to the inflationary pressures that these trillions of additional dollars are going to continue to add to our economy and continue to add to the debt that our children are going to continue to bear. And it's amazing to me that not one Democrat in Congress is willing to speak out about this. So, Chairman Powell, why is the Fed maintaining its emergency monetary policy posture right now, and why do I understand that it may continue well into 2023?
So where we are is we're watching the evolution of the economy. We're noting that there's still an elevated level of unemployment. We note that inflation is well above target, and we've discussed that. And we've said that we would begin to reduce our asset purchases when we feel that the economy has achieved substantial further progress measured from last December. So we're in active consideration of that now. We had a full meeting last month to discuss that. We've got another meeting coming up in 2 weeks. So we'll be making that assessment. And as we assess the progress of the economy toward that goal, we will begin to reduce our asset purchases. We've set a separate test for raising interest rates, which is a higher test. And so that's how we're thinking about this today.
The policy positions that have been undertaken by this administration go far beyond the transitory nature that you described. And again, if I think about the expectations of the people in my home state, they're very, very concerned about inflation, so I'd like to pass that along. I'd also like to ask you just a very simple question. Does continued government stimulus spending at this point make your job in terms of sustaining price stability more difficult?
So we're not in the business of giving Congress advice on fiscal policy, and I just have to leave that to you. We take whatever you do and we put it into our considerations of policy, but we don't comment on it one way or the other.
Thank you, Mr. Chairman. Thank you, Chairman Brown.
Thanks, Senator Harrigan. Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So the chairman of the Federal Reserve has two basic jobs: monetary policy, which everybody likes to talk about, and regulatory oversight, which is often way down in the weeds, but keeps our economy safe from another banking meltdown. You've been chair for 4 years now and have gone through the process of what you describe as, quote, tailoring the regulations put in place after the 2008 financial crisis. Now, there were a lot of changes, but I want to talk about a couple in particular. To prevent taxpayer bailouts, banks are required to have living wills. This means that banks must be able to show every single year how they could be shut down without wrecking the entire economy. In 2019, you changed the rules so that the 13 banks with $250 billion to $700 billion in assets could submit full living wills only once every 6 years instead of every year. So that test is now weaker. Chair Powell, has the Fed done anything over the past 4 years to make living will requirements stronger?
To make living will requirement, we've done a lot of things to strengthen regulation and capital, but I think
on living wills, I
can explain what we.
So let's move to another regulation, the Volcker rule, the rule that works sort of like Glass-Steagall light to separate commercial banking from Wall Street risk taking. In 2019, you exempted more short-term trading holdings from the rules, so banks could take on a little more risk. Now, that weakened the rule. Then in 2020, you eased up the rules to let banks invest more of their assets in high-risk private equity and hedge funds. So the Volcker rule got weaker again. So let me ask, Mr. Chairman, during the past 4 years, has the Fed done anything to make the Volcker rule stronger and limit risky trading for the largest banks?
I think by clarifying it, we made it more effective at what it's supposed to do, which is just what you said.
Well, I have to say, it's whether or not you did anything to make it stronger, not just whether or not you made it clearer. It's whether or not you made it stronger or harder for banks to engage in speculative trading. So I'm taking it that the answer here is no. I've highlighted 2 examples of weakening regulations, but there are a whole lot more. Reducing capital requirements, easing liquidity requirements, shrinking margin requirements, scaling back on supervision, weakening the stress test. It's a long list, and I realize that you think these are good changes, but I'm trying to look at this from a regulatory perspective. Is the chairman of the Federal Reserve making banking rules stronger or weaker? So tell me, Mr. Chairman, is there a big rule change that I missed? Can you name a change that strengthened the rules and made the actual rules tougher?
Well, let me say we did not weaken capital requirements for the largest banks, and I actively resisted any move in that direction. And in fact, the stress capital buffer, which we implemented quite recently after years of consideration, raises capital standards for the largest banks. By the way, stress tests, they're really bound by the stress tests. We maintained the very high stringency of the stress tests through this period.
So, but what I was asking about anything tougher, look, what I'm looking for is that the Fed's record over the past 4 years, I see one move after another to weaken regulation over Wall Street banks. And that worries me. There's no doubt that the banks are stronger today than they were when they crashed the economy in 2008, but that's the wrong standard. The question is whether or not they are strong enough to withstand the next crisis, and whether the Fed is tough enough to protect the American economy and the American taxpayer. In 2020, the giant banks that are the beneficiary of these weakened rules made it through the crisis. But the researchers from the Minneapolis Fed found that the banks would have faced up to $300 billion in losses if not for fiscal stimulus from the government. In other words, the current Fed rules were not strong enough for the banks to withstand the pandemic without, once again, calling on American taxpayers to back them up. And that's the heart of my concern. I understand that the next crisis may feel far away, but like the pandemic, it may come at us fast and from an unexpected direction. It is the job of the Federal Reserve, and specifically the job of the chair of the Federal Reserve, to use the regulatory tools that Congress has created in order to make sure that banks remain strong and that taxpayers will never be called on again for a bailout. Thank you, Mr. Chairman.
Thank you, Senator Warren. Senator Tillis from North Carolina is recognized for 5 minutes.
Thank you, Mr. Chair. Chairman, thank you for being here. I wanted to go back and maybe give you an opportunity to respond to one question. You were going to explain the work on living wills. Would you like to explain what the work you've done there?
I would just say that's was an incredibly labor-intensive and taxing issue that we went through cycle after cycle after cycle, and really the marginal gains from doing it every year diminished quite a lot. And so we concluded that for the largest banks, we wouldn't require a full resubmission except every other year. But they have to anything that's material, they must resubmit. I don't think in any way we've weakened our understanding of their resolvability or anything like that. I would also say we raised capital standards on the largest banks, full stop, in the stress capital buffer. They're higher now than they were. So I would say that.
With respect to the Volcker rule, you were talking about clarifications. I mean, is the Fed fully enforcing the Volcker rule based on congressional intent?
Absolutely. Look, I think it's important. It's more broadly, I would completely agree that our job is to maintain the strength of these large financial institutions so that we never have to worry about bailing them out again. And I'm strongly committed to that. You know, we need them to be very, very strong so that they can perform the roles that they're supposed to perform, even in a severe crisis. And I think they by and large, did, admittedly with a lot of fiscal support and a lot of monetary support too. We can always do better, but we are committed. I am committed to that.
Thank you. I've got to beat the inflation drum for just a minute here. The FOMC members insist inflation is transitory, but it hasn't inspired a lot of confidence in me. There was a couple of statements by President Mary Daly. In February, she declared the pressures on inflation now are downward. In May, when inflation readings were at 3.9%, she said the higher inflation readings would mean 2.4 to 2.6%. In June, she was predicting that inflation could go above 3%. And despite months of relatively low ball projections, and in response to Tuesday's high inflation readings, she confidently declared, we expect a pop in inflation like this. So I hope from our perspective, you could see that we're skeptical about some of the inflation projections. And I've spoken with a number of people in the financial services industry, and when I ask them the question about transitory, I'm getting more of a response now of transitory-ish. So can you give me a reason why you believe the Fed's position on it being transitory, that it will snap back, why that's still well-founded?
Sure. So let me start by saying that no one has any experience of what it is to reopen the economy after what we went through. And so all of us are going to have to be guided by data and our views are going to have to be seasoned.
Chairman, let me interrupt you for a second. I'd also like for you to answer that question in the context of the flow of money that's been passed in the prior COVID relief packages. And we heard an announcement this week from the Speaker of the House and Senator Schumer that they have an agreement on another $3.5 trillion. I'm a part of a working group for infrastructure that could add about another $600 billion. So answer the question in the context of how that future, according to the leadership of Congress, outcome is going to occur. How does that all fit into the credibility of future inflation projections?
So when we look at inflation, we look in the basket of things and we say which of the 100+ things in the CPI basket are causing the high inflation reason. And it comes down to really a handful of things, all of which are tied to the reopening. It's used, rented, and new cars. It's airplane tickets. It's hotel rooms, and it's a handful of other things. And they account for essentially all of the overshoot. And we think that those things are clearly temporary. We don't know when they'll end, but they'll go away. So we don't know when they'll go away. We also don't know whether there are other things that will come forward and take their place. You know, what we don't see now is broad inflation pressure showing up in a lot of categories. The concern would be if we did start to see that. We don't see that now. We'll be watching carefully. And we won't have to wait, a tremendously long time, I don't think, to know whether our basic understanding of this is right. We will know because we'll see other more. If we see inflation spreading more broadly, that'll give us information.
I just want to get one more in. I appreciate that, and I listened to your responses from some of the other members. With the LIBOR transition, do you still view, I think you publicly stated Ameribor as a reasonable choice for regional and community institutions. Do you still stand by that?
You know, we don't like to bless individual rates, but I would just say market participants have the freedom to choose the rates that they want to choose. We're not forcing them to use. This is for just use.
But I am confirming
uses LIBOR.
In some public comments, you have said it's an appropriate rate for banks and funds through the financial exchange, American Financial Exchange. You still stand by that statement?
I saw that. I don't remember saying that, but it was in a letter, I think. So
okay,
I must have done it.
Thank you, Mr. Chairman. Appreciate your work.
Thank you.
Thank you, Senator Tittle. Senator Tester of Montana is recognized for 5 minutes.
Yeah, thank you, Chairman Brown. I want to thank Chairman Powell for being here today. A lot of chairmans around here. But look, I have appreciated you, and I've appreciated your work during your tenure, and especially as we look back over an incredibly difficult period of time where you were having to take a lot of issues that we hadn't seen in 80 years under consideration, getting attacked, trying to politicize the Fed. I just want to thank you. I appreciate it. I think your expertise and your knowledge has shown through. The cream has risen to the top, so to speak. So, thank you. Look, there's a lot of talk about infrastructure needs, and I think that you would probably agree that China is trying to take over our role in this world of being the economic superpower. And I'm one that believes that infrastructure and investments in infrastructure is critically important if we're going to maintain our position as a worldwide economic power, the worldwide economic power. My question for you is you look at infrastructure investments and how that affects our economy, where would you put your focus?
I don't have any. I mean, I would just say that well-spent, well-invested infrastructure money does have the ability, and it's really up to you to make those decisions. But it's the kind of thing that can actually raise the growth rate, the potential growth rate of the country over time. But I guess I need to leave the details.
So I think that there's several proposals out there. There's proposals to invest in roads and bridges and broadband and grid, which some of us in this room are a part of, that I think is really, really important. I think there are other proposals that are also very important, but they're investing in a different kind of infrastructure like childcare and workforce housing and those kind of things. I don't mean to put you on the spot, but I do value your opinion. Where do you think those things fall? Are they equally as important, or do you think that the economy is fine without any investment in those kind of things like housing and childcare and that kind of stuff?
I don't want to get into. I wouldn't get into the debate over whether those are infrastructure or not. But
right? No.
I'm
just from an economic standpoint.
From an economic standpoint, take childcare. We used to have the highest female labor force participation rate among the advanced economies. Now we're close to the bottom of the pack. And one of the differences economic researchers point to, there's a lot of research on this, is just a different approach on childcare. And it's really up to you to look at that and see whether that makes any sense in the U.S. context. We don't have an opinion on that, but that's a basic economic trend where we used to lead and we don't anymore.
Okay. So let me ask you this. I don't know. I know that many in the Fed have done some work on issues in Indian country, and one of the issues in Indian country is housing. They have a different situation because of their sovereignty and as of not having the kind of collateral that folks who own property have, that land on the reservation I'm talking about. Do you have any thoughts on that, on what we could be doing outside of the whole infrastructure conversation? Just what can we do to impact Indian country when it comes to housing? Because, man, it's woefully bad.
That's a hard question, and as you know, we have 4 or 5 reserve banks that are involved, particularly Minnesota, Minneapolis, in Indian country issues. We're not allowed to spend. We don't spend taxpayer money on things directly like that. But I think we would agree that there's a significant housing issue in Indian country, and I'm not sure I have the answer.
So if you have if you have any ideas that pop into your head about how we can, I don't know, incentivize is the right word, but how we can engage the private sector to do some housing so that they would be more inclined. And look, I get their point of view. It's not traditional. They don't have the kind of collateral that they would have with fee property. So it is an issue. Look, I appreciate what you're doing. I'm about out of time, but I just want to thank you for your work. I appreciate you being in front of the committee today, and good luck.
Thanks.
Thanks, Senator Tester. Senator Shelby from Alabama is recognized for 5 minutes.
Thank you. Chairman Powell, we've been talking about inflation, and it's not going to go away, I think, for a while, so we're going to continue to talk about it, and you'll be concerned with it. In June, U.S. inflation accelerated at its fastest pace in 13 years. Consumer prices increased by 5.4% from a year ago. Americans are now paying higher prices for many of the goods and services that they cannot do without. The buying power of the dollar has diminished over the past 40 years. I'll give you some examples. You know all this. According to the Bureau of Labor's Consumer Price Index, $1 today is 7 times less valuable than it was in 1970, 3.5 times less valuable than in 1980, half as valuable as 1990, and 1.5 times less valuable than 2000, which seems like yesterday. Recently, the price of commodities, as you know, has increased swiftly. The price of agricultural goods, commodities, has increased. Corn by 50% from a year ago. Wheat by 17%. Soybeans by 54%. The price of metals has risen. For example, copper, which is used everywhere, has increased 43%. Aluminum has increased by 47%. Energy prices, as you know, again, have grown. The price of crude oil has increased by 70%. Gas prices are up 45%. In the automotive industry, prices for used cars rose 45% in the past year, 10.5% in June alone. Airline tickets are up 25%. The cost of milk is up 7.5%. All of this on the rise. At this point, the Biden administration continues to claim that the increases in inflation are temporary. I, along with others, believe that this could be the sign of things to come. We hope not. For instance, economists surveyed by the Wall Street Journal this month forecasted higher inflation for the next couple of years. Throughout the 70s, as you will recall, high inflation crippled consumers with rapid and sudden price increases. Many of those conditions exist today, such as loose monetary policy and significant government spending. If we fail to take inflation seriously, Mr. Chairman, I'm concerned that our nation could be faced with the same challenges of years ago. Yet in the midst of the increase in consumer prices, which I've just related, the Biden administration is proposing trillions more in government spending. The Fed's ability to maintain price stability is threatened, I believe, by actual or inflation or the expectation of inflation. Chair Powell, my question is this. Taking all this into consideration, which you have data that we probably don't have, do you believe that this nation, our nation, is facing a real problem with inflation? And if not, why not? How do you justify it?
I think we're experiencing a big uptick in inflation, bigger than many expected, bigger than certainly than I expected. And we're trying to understand whether it's something that will pass through fairly quickly, or whether in fact we need to act. One way or the other, we're not going to be going into a period of high inflation for a long period of time because, of course, we have tools to address that. But we don't want to use them in a way that is unnecessary or that interrupts the rebound of the economy. We want people to get back to work, and there are a lot of people who are not back to work yet. So, but let me say, very well aware of the risks from inflation, watching very carefully, and you know, if we come to the view that, or if we see inflation expectations or the path of inflation moving up in a way that's troubling, then we will react appropriately.
Are you concerned about all the things that I just related, all the price increases, unprecedented in recent years, or are you just putting that aside?
No, I mean, we're you know, night and day. We're all thinking about that, and really asking ourselves whether we have the right frame of reference, the right framework for understanding this.
Lastly, do you agree with the economists that I referenced, that the Wall Street Journal poll, who forecast higher inflation rates for the next couple of years, notwithstanding.
So that was the headline writer really got a little carried away there, because the actual forecast showed that the median for 2022 was 2.3% PCE inflation, and for 2023, 2.2% PCE inflation, which is not at all different from the forecasts of the people on the Federal Open Market Committee. So those are higher than for the last 30 years, but they're not that high. So that forecast was not really as problematic as the headline suggested.
Thank you, Mr.
Thanks, Senator Shelby. Senator Cortez Masto is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, welcome back. Let me follow up on this. Are you confident that you have the tools that you need to address any type of inflation, whether it's transitory or for the future, that we are looking at right now?
Yes, I am.
Thank you. And can I ask, in considering inflation, how should we compare costs to last summer when prices were well below their current levels because of the pandemic?
I think it's actually, in the spirit of your question, it's better to compare prices to prices where they were in February. And if you look at inflation since then, that captures both the decrease and the increase. And you get much lower numbers if you do that. There are a lot of people doing that right now. So you get inflation in the mid-2s, which is still above our target, but that sort of 16-month inflation on an annualized basis is 2.5% kind of thing, not 5%.
Thank you. And then for purposes of the COVID relief packages, all of them, including the most recent one, the American Rescue Plan, is that the sole cause for what you see with respect to the minimum increase in inflation?
I think a lot of things go into it. You know, the main thing is that we have demand rebounding very, very strongly. That's partly monetary policy. It's partly the fiscal policy. And what we see on the supply side is a supply side that just can't keep up with this demand and all these bottlenecks. And by the way, it's happening everywhere in the world. So it's a combination of factors.
And so unlike the last recession that we lived through in 2010 to 2014, would you, I'm curious, would you, and this is my interpretation of it, is that when our economy opened up from that, it was a gradual opening up of our economy again. And this is more of a kind of a light switching on with the economy opening up quickly. And that's why we see some of the concerns with supply and demand on so many different areas. And that's why we see highly concentrated sectors where there's a demand like you've touched on tonight or today. Is that accurate?
It is accurate, and I would add that the response, both from fiscal and monetary policy in this episode, is just orders of magnitude different from what has happened in the past. So we're back to pre-COVID levels of economic output, and we're on a path to be above the prior trend, actually, within a year if forecasts prove out.
Thank you. You know, in Nevada, our employment rate has fallen sharply since the pandemic last spring. Unfortunately, we are still fourth in the nation for unemployment. But as I watch our economy open up again, and particularly you and I have talked about this, as tourism and travel industry is starting to rebound again, which is fantastic. Last month, more than 130,000 people applied for 6,000 positions at a new resort in Las Vegas. Part 5 of the Federal Reserve Monetary Policy Report notes that, and I quote, payroll employment increased by 3.2 million jobs in the first half of 2021, driven by a 1.6 million job gain in the leisure and hospitality sector, where the largest employment losses occurred last year. The May 2021 Federal Reserve research paper, however, found that the extra jobless benefits that were provided during the pandemic, quote, and I quote this, likely had little or very small labor supply induced impact on the unemployment rate. Can you elaborate on that?
So I think that was Reserve Bank research, and I think it was referring to 2020. It's too soon to really say what the facts are going to be here. In fact, we'll be able to learn something because many states, as you know, have stopped the additional benefits, and we'll be able to look and see whether that had any effect on people going back to work. It's way too early to say. There's not enough data.
And thank you for saying that, because that was my next question. You will be studying that data to see the difference between those states that cut it off early versus those that kept it going, whether that truly was an impact or not
Yes, everyone's looking to see whether there will be a meaningful difference between the two. And again, too early to say on that.
I appreciate that. Thank you. And then finally, we touched on housing. We are seeing this home prices are up more than 15% since last year. How much of the rise in home prices do you think are due to the Federal Reserve's purchase of mortgage-backed securities versus the supply issues?
So I think that our purchases of treasuries and MBS are what is holding down and also holding interest rates low. The overall picture of accommodative monetary policy is contributing to what's happening in the housing market. I think mortgage-backed securities are contributing probably a little more than treasury securities, but ultimately it's roughly the same order of magnitude. So, sorry, was that your question?
Yeah, thank you. No, I appreciate that answers my question. Thank you very much.
Thank you.
Thanks, Senator Cortez Masto. Senator Daines of Montana is recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, good to have you here today. And thanks for keeping a steady hand here during these rather tumultuous times. I want to start by joining my colleagues in expressing my concern with the inflation we're seeing in the economy. This week, we received 2 inflation readings. They were the highest increases we've seen in over a decade and reflect what Montana families are already feeling, and that is prices for everyday necessities, they're going up. At the same time, Majority Leader Schumer, Senator Sanders, Senate Democrats are proposing another massive partisan $3.5 trillion tax and spend package. I truly believe this is reckless. It threatens short, medium, and long-term prosperity of our country, and I sincerely hope my colleagues on the other side will reverse course. With that, I'd like to turn to my questions. Chairman Powell, the unemployment rate has consistently fallen since the height of the pandemic. Now at 5.9%, down from a pandemic high of 14.8% back in April of 20. I'm truly grateful, as I know you are, to see this rate fall, more Americans getting back to work. However, we're kind of digging into this and have concerns about the labor force participation rate, which now sits at 61.6%. It's remained in a narrow band between about 61.4 and 61.7% since June of 20. The current labor force participation rate is 1.7 percentage points lower than it was pre-pandemic in February of 20. A significant percentage of those folks who've dropped out of the labor force are over the age of 55. And recent data shows that they're not re-entering the workforce. A lot of those folks, as they are already nearing retirement age, may never re-enter the workforce. And my question, Chairman Powell, is do you expect the labor force participation rate for those 55 and older to recover to pre-pandemic levels? And if so, why?
So you very accurately described the situation. People, toward the end of the last expansion, older people were staying in the labor force longer. And as a result, for years and years, we were seeing higher readings on participation than we expected, which was a good thing, we thought. You know, we want the U.S. The U.S. has a low participation rate compared to our peers, surprisingly, but it does. So the question is, what's this going to, and then a lot of those people retired. 3 million people left the labor force, and it tended to be older people actually retiring. And the question is, what's going to be the equilibrium once the economy is going full bore again? Labor force participation tends to lag recovery, tends to lag unemployment recovery. So when labor markets get tight, we tend to see this. So I would just say, first of all, a lot of humility is appropriate here. We don't know what the trend labor force participation rate is, but we went through 8 years of watching labor force participation be higher than we expected, and I fully took that on board, and I think the U.S. can do much better in terms of labor force participation. So I'm not going to close my mind to the idea that we might get back to those.
Yeah, well, thanks for the thoughtful answer. I guess if that participation rate for those 55 and older permanently remains below the pre-pandemic levels, how might you see that impacting the time it might take the economy to get back to full employment, and what impact might that have as it relates to inflation?
Well, so if there's less labor supply, then you'll hit full employment earlier. As you know, obviously, we consider a broad range of indicators, not just unemployment, also participation, wages, and those things. But you presumably, if there's less labor supply and lower participation structurally, then you would see that in the form of higher wages and higher inflation. We'd be able to see that.
Chairman Powell, thank you. I want to get to my last question here, and that's regarding the balance sheet of the Federal Reserve. It recently eclipsed $8 trillion, which is more than double where it was before the pandemic. When, if ever, do you think the Fed's balance sheet will fall below $8 trillion? And could you describe what the risks are if the balance sheet remains at this elevated level for an extended period of time?
So we have the last cycle as an example. What we did was we slowed the pace of asset purchases, and then we froze the size of the balance sheet for a period of years. And as the economy grows relative to the balance sheet, you know, the size of the balance sheet relative to the economy becomes smaller. So we did quite a bit of that. And then for a couple of years, we actually let the balance sheet run off and shrink. As securities matured, we stopped reinvesting them and we let the balance sheet shrink at the margin. We haven't made those kind of decisions yet, but it's a reasonable starting place to think that we might hold the balance sheet constant for some time and then perhaps allow it to shrink under $8 trillion. In the meantime, it becomes smaller as a portion of the economy, and that's the same thing as shrinking in a way.
Great. Thank you, Mr. Chairman.
Thank you, Senator Dane. Senator Van Hollen of Maryland is recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Toomey, and Mr. Chairman, welcome. I've heard the term unprecedented used to describe the jump in inflation. I think what's truly unprecedented is the number of jobs we've seen generated since President Biden took office. 3 million jobs, the highest rate of job growth of any president in United States history, as we work seriously to defeat the pandemic and as we pass the American Rescue Plan to give confidence to people in the future of the U.S. economy. I do want to dig a little deeper into the inflation issue because you've made the point clearly here today that you believe it's a temporary increase, and if you look at long-term projections, they're closer to your targets, and that's also the expectation of folks in the financial markets as well. Isn't that the case?
Yes, broadly speaking.
And it's interesting how a short period of time changes things. I'm looking at remarks you made in May 2019 when people were afraid that the inflation rate was too low and below your targets. And at that time, you made the point you thought it was transitory, and you were right. And you used a different measure of trimmed mean CPI to describe your thinking. Can you just talk a little bit about what that measure is?
Sure. One thing that people do at times like this is they chop off the tails and just look at the middle of the distribution, because sometimes the overall inflation measure can be distorted by just a couple of categories. So if you did that here, this is the Dallas trimmed mean, and the Cleveland does a version of this. You know, it's going to show inflation that's in the low twos because you're getting rid of that small group of categories. You know, the risk is that you shop for whatever inflation measure that is appropriate at the moment. So we try not to do that. But just clearly, trimmed mean is sending a signal that this is more idiosyncratic than broad across the economy.
Right. And isn't it the case that the increased prices of used cars rose by 10% in June alone and accounted for more than 1/3 of the entire increase in the CPI in June?
Yes, it is.
Right. So, I mean, those are the kind of anomalies you're referring to, right?
It's used cars, new cars, rental cars, it's airplane tickets, it's hotels, it's all things that have a story that's clearly related to the pandemic. At least that is what it is now.
Right. So, I think rather than rush to create alarm about inflation, I think we should all be together in focusing on important increases in job growth and wages that we're seeing. I know you said yesterday that you expect that we should be able to get back to 3.5% unemployment as we move forward. I know Secretary Yellen's talked about maybe this time next year. I am worried, and we've discussed this in the past, about persistent long-term unemployment. And if you look at the June numbers, the long-term unemployed, and these are individuals who've been jobless for more than 27 weeks or more, increased by 233,000 to 4 million total. That followed a decline in long-term unemployment in May. So my question is is there any way we can get back to 3.5% unemployment if we don't get this number down when it comes to the long-term unemployed?
Well, we saw that what a really strong labor market does is it pulls those people in and also pulls people in who are on the sidelines or keeps people from leaving. So there's just so much to like about a really strong labor market.
And I agree with you, Mr. Chairman. If you look even before the pandemic, though, in February before the pandemic, 3.5% unemployment, we had over 1 million Americans who were long-term unemployed. So yes, we hope that the growing economy will be a magnet, and I'm sure it will. It is going to bring a lot of people into the job force. I think all of us are concerned about labor force participation. I think a stronger economy will address that. But there is this group of long-term unemployed, and my concern is, as you well know, the data shows the longer you're unemployed, the harder it becomes to get back into the workforce. Then you get in at a lower wage, which stays with you throughout your career. Do you believe it's worth the Congress considering? I know this is not your domain to be specific about what. Deliberate policies like wage subsidies, which we used successfully back in 2008. Those kind of deliberate policies to make sure that the persistently unemployed, long-term unemployed can get back into the labor force.
I would, again, without trying to endorse anything in particular, we lag all of our peers in labor force participation now, which is not where we want to be as a country. And I do think that's a classic supply side policy is to try to find ways to connect people, to give them some help in connecting to the labor force, and then they need a strong job market to pull them in and keep them there. But I do think those things are worth looking at.
I appreciate that. Thank you, Mr. Chairman. Hope we'll do that.
Thank you, Senator Van Hollen. Senator Kramer of North Dakota is recognized for 5 minutes.
Thank you, Chairman Brown, Ranking Member Toomey. Thank you, Chairman Powell, for being here. First of all, let me add my voice to the chorus of people to thank you for your cool head through this process, particularly for resisting the pressures to lower rates when it wasn't necessary, so we had some room when it became very necessary. Appreciate that very much. Now, I was interested in a lot of the discussion going on. I was particularly interested in listening to your exchange with Senator Hagerty, where you used the line that I've heard you use many times when he asked a question about what Congress ought to be doing. You said, and I think this is a direct quote, "We are not in the business of giving fiscal advice to Congress either way." And again, that's similar to what you've said many times. Yesterday, thinking about this, I did a quick search engine review of the words "Fed Chair urges Congress." And this won't surprise you. And by the way, there's not a person in this room that doesn't have some sympathy over headlines that aren't quite accurate or even quotes. But one report in May of last year says the Fed chairman asked Congress to consider more stimulus. October of last year, Jerome Powell is putting out the call to Congress, more money now. November of last year, Powell still thinks U.S. needs more stimulus for full recovery. Even in December of last year, Fed Chair Treasury urged Congress to give U.S. a stimulus bridge. In other words, you haven't always resisted the temptation to give us fiscal advice. And by the way, thank you for it. I think it was good advice. Maybe we look back and say, well, maybe we did too much, but we were in a crisis. You did what you needed to do. We did what we needed to do. And I don't think there's a lot of regret about that. Now, a number of my colleagues have pointed to what's gone on lately and what's being suggested going forward. In addition to the $3.5 trillion package, it includes a lot of tax increases, like 7 times more increase than the cuts from 2017 that built the foundation for this quick recovery, I might add. You add in the $1.9 trillion totally unpaid for earlier this year, the $0.6 trillion in new spending as part of the $1.2 trillion bipartisan package that's being discussed. It's, you get to $6 trillion plus really, really fast. What people aren't talking about is if we end up at the end of this fiscal year passing a 1-year CR or something similar to a 1-year continuing resolution, we're going to spend another $6.845 trillion, $3 trillion of which will be deficit spending. Deficit spending. Now, my question to you is very direct, and And that's just simply, does the economy need another $6 trillion plus another $6.8 trillion spent this year to enhance the recovery? And is there not a detrimental effect to all of that, including the tax increases, when we are, in fact, in a, call it whatever you want, type of an inflationary time, but it is uncertain, and there's concern, if not alarm.
If I can answer that by saying, you know, we did a lot of things. I did a lot of things last year that we'd never done before, and that one in particular, I had a lot of encouragement from the administration and leadership on both sides of the Hill in both parties. But I swore it off, and I do think we should go back to regular order, which is that the Fed doesn't play a role in fiscal policies. It's not a national emergency like it was at the time, and I've been trying very hard so far this year, succeeding in not getting involved in giving fiscal advice. So I'm just going to have to, whatever you do, we take it into account in our policies, but we don't come out then and comment on whether we think this is a good idea or a bad idea. Sorry.
Well, okay, I appreciate that. Maybe just one other quick question. We noticed that the Fed is continuing to pour some, or pumping some liquidity through the purchases, mortgage purchases, particularly, obviously, Fannie and Freddie. I mean, is that, do you see that as continuing to be necessary? Obviously you do, or you're doing it, but why?
So, as you know, we're looking at that right now. We're looking at, my colleagues and I on the Federal Open Market Committee are having a second meeting about that in a couple of weeks. And we're going to talk about the composition of our asset purchases and the path to beginning to reduce them. And I wouldn't want to judge that, but this is something that's very much on the table.
I might just add real quickly, with regard to climate risk that you've heard a lot about today, whether it's political or true risk, I would just want to remind my colleagues that in energy or climate manufacturing, U.S. economy or U.S. investment, do not forget that every time we don't invest in energy or climate manufacturing issues in the United States, another country that doesn't do it as well as us is going to do it as well. And this is climate change is a global issue, so let's think about risk in a global context. Thank you, Mr. Chair.
Thank you, Senator Kramer. I am going to go vote. Turn it. Senator Ossoff is next. A Republican, Senator Lummis, we think is coming back, or perhaps Senator Crapo, maybe, and then Senator Reid will go. But Senator Reid will chair, and Senator Ossoff is recognized for 5 minutes.
Thank you, Chairman Brown, Ranking Member Toomey. Thank you, Chairman Powell, for your service and your testimony today. Obviously, over the last 18 months, the COVID-19 pandemic has been the most significant shock to our economy and the financial system. But stepping back, what do you assess to be the most significant systemic threats to financial stability over the medium term, either limited to the U.S. or globally?
I'd have to say that the thing that worries me the most about it is really cyber risk. You know, it's a constant concern, and we spend lots of time and resources on it. So does the private sector, but that's the one where we have a playbook for bad lending and bad risk management. We have a lot of capital in the system, but the cyber, as you see with the ransomware issues now, it's just an ongoing race really to keep up, and we haven't had to face a significant cyber event from a financial stability standpoint, and I hope we don't. But that's the thing I worry the most about.
And in terms of threats to financial stability following cyber, what next preoccupies your attention or concern?
The economy's coming out of this globally, coming out of this pandemic. So I would worry about if we don't succeed in vaccinating people all over the world, really, we're creating time and space for the development of new strains of the virus, which can be more virulent and more difficult to fight. And I worry that could undermine the economy and ultimately financial stability. The last thing I'll say is, we're at the point in the risk cycle where people are looking out 4 or 5 years and they're seeing pretty good economy. We're heading to I think a strong labor market, highest GDP in 7 years. This is the time when risk takers can begin to forget that there's a bad state of the economy out there waiting for them at some future date and take too much risk. And so from a supervisory and regulatory perspective, we're very mindful that it's a time when we need to keep people focused on risk management.
That's a great segue to my next question, which is given the extraordinary provision of liquidity, not just since COVID-19, but over the last 15 years, how concerned are you that credit committees at major financial institutions and others allocating capital are acting with sufficient prudence given the easy access to capital?
You know, financial conditions are highly accommodative. People are getting things financed. SPACs and things like that are getting done. We see Bitcoin going up in value and down in value. So at times it's felt like a somewhat frothy market. You do worry about that. At the same time, we're very focused on the real economy. Our jobs are maximum employment and price stability, really, and also financial stability. But we've got a long way to go, so we want to be careful about tending to our main mandate while we also think about financial stability issues.
What is your level of confidence that there are not risks lurking in the non-bank financial system, hedge funds, private equity, SPACs you mentioned, given the provision of all this liquidity and the reduced visibility that regulators have into some of those institutions?
So there's lots of risk-taking going on in the non-bank financial sector. Much of it can take care of itself. Private capital can absorb losses. We know from the experience of the last crisis and the one before that there are structural aspects of the non-bank financial sector that really need need better regulation and better structures, and that's particularly money market funds, which twice have had to be bailed out in the acute phase of the crisis. I think we saw that the Treasury market really lost functionality, the most important financial market. It lost functionality significantly during the acute phase of the crisis, and we're doing a very careful analysis and thought about whether there needs to be some structural strengthening there and other aspects as well.
Turning finally to climate change. The Fed's most recent financial stability report cited climate change as a potential threat to financial stability. The National Oceanic and Atmospheric Administration, our country's foremost meteorological agency, states that impacts from climate change are happening now. They cite risks including changes to water resources, floods and water quality problems, challenges for farmers and ranchers, increases in waterborne diseases, rising sea levels that put coastal areas at greater risk. The Department of Defense identifies climate change as a critical national security threat. What is your assessment of the risk that climate change may pose to financial stability or to your dual mandate of full employment and price stability in the long run?
Well, I think it has implications for all of those things in the long run. We're very focused on the risks that individual financial institutions are taking and working with them to make sure they understand the risks they're running and can manage them and address them in their business model. More broadly, in financial stability, financial markets generally, and non-bank financial institutions, it's much the same. We know that the transition, for example, to a lower carbon economy may lead to sudden repricings of assets or entire industries, and we need to think about that carefully in advance and understand and be in a position to deal with all of that. We're doing all of that work, as are other researchers and central banks and governments around the world. There's a lot of work going on this, and it's a high priority, but a longer term issue in terms of the financial stability. I mean, I think the manifestations of climate change are here now, but the financial stability issues are really coming.
Thank you, Chairman Powell. I yield, Mr. Chairman.
Thank you. On behalf of Chairman Brown, let me recognize Senator Loomis.
Thank you very much, Mr. Chairman, and welcome. Good to see you again. My first question, as you might guess, is about digital assets. You had testified yesterday in front of the House Financial Services Committee that one of the stronger arguments in support of a central bank digital currency was its potential to render stable coins and virtual currencies unnecessary. But in March, you acknowledged that Bitcoin, Ethereum, and other virtual currencies are essentially a substitute for gold rather than the dollar. So I want to talk a little bit about the difference between the two. So it's pretty clear that Bitcoin, Ethereum, and other virtual currencies are investment commodities and not payment instruments. The SEC and CFTC have said as much in court cases and regulatory actions. So I think what you were trying to get at is one of the best arguments for a central bank digital currency is that stable coins could be rendered unnecessary. But legally speaking, stable coins and virtual currencies are not synonymous because stable coins don't increase in value generally and are used as substitute payment instruments, whereas Bitcoin, Ethereum, and other virtual currencies are investment assets. There's research from Fidelity, Deutsche Bank, and Credit Suisse, among others, that call Bitcoin an emerging store of value. Goldman Sachs has also said the same about Ethereum. And so my question is, because stablecoins and a central bank digital currency are more synonymous with the dollar as a instrument of payment, and Bitcoin, Ethereum, and other virtual assets are more an investment commodity like gold, when you spoke to the Financial Services Committee in the House yesterday, did you mean that stablecoin would be unnecessary if we had a central bank digital currency?
You're basically, you're right. But let me say, though, with cryptocurrencies, it's not that they didn't aspire to be a payment mechanism. It's that they've completely failed to become one, except for people who desire anonymity, of course, for whatever reason. So that's why I included them. But I would completely agree. Really, the question is stable coins. And my point with stable coins was that they're like money funds, they're like bank deposits, and they're growing incredibly fast, but without appropriate regulation. And if we're going to have something that looks just like a money market fund or a bank deposit or a narrow bank, and it's growing really fast, we really ought to have appropriate regulation, and today we don't.
And I would assume, thank you for that. I would assume that you would agree that some common definitions and kind of a clear legal framework would help us understand the opportunities associated and the risks associated with financial innovation.
Yes, I could certainly agree with that.
Thank you. Thanks so much. Now I want to turn to monetary policy, and I'd like to draw your attention to this chart. Federal Reserve and Bureau of Economic Analysis M2 data shows that deposits and close substitutes held by households have generally averaged 51% of GDP from 1952 to 2021. But then data from the end of Q1 of 2021 shows that households are sitting on deposits and close substitutes of approximately 79% of GDP today. So that's roughly 28% or trillions of dollars above the historic average. So going back to 1952, there's never been a higher percentage of household deposits to GDP. Monetary policy also has been highly accommodative over the last 16 months to the tune of 32% increase in the M2 money supply. So I haven't heard anybody talking about this hidden stimulus. And when households start to spend this cash, combined with the enormous liquidity already out there, it seems there's real potential for inflation to continue to overshoot. We've already seen it this week as the core consumer price index number was nearly double what economists had predicted. So here's my question. Is it really wise to continue to have accommodative policy when there's still trillions of household cash that will flow into the economy soon?
So this, I think the main factors driving this up are really that people have been sitting at home for a year and a half, not able to travel and go on vacation and spend money in restaurants and things like that, and also combine that with the major fiscal transfers that Congress made. So there's a lot of cash, as you know. There's a great deal of cash on household balance sheets, and that's what this is representing. Is it appropriate for us to continue accommodative policy? We think it is, but as you know, we're in the process of evaluating, when it'll be appropriate for us to taper, which is to say reduce our asset purchases. We're having a second meeting that'll address that topic directly in a couple of weeks. So, but for the time being, the other thing I'd point out is there's still a lot of unemployed people out there. And we think it's appropriate for monetary policy to remain accommodative and supportive of economic activity for now.
Thank you for your responses. Thank you, Mr. Chairman. I yield back.
Thank you, Senator. On behalf of Senator Brown, I'll recognize myself, and at the conclusion of my comments, I will yield to Senator Warnock, and by that time, I presume Senator Brown will be back to conclude the hearing. But I will ask first. So, first of all, thank you, Mr. Chairman, for your remarkable service over these many challenging months. I appreciate it very much. One of the aspects of the pandemic has been an indication of the potential for technological displacement of workers. I think we're all now familiar with Zoom. In fact, it's a blessing and a curse simultaneously. But as you look forward, how are you factoring in this notion of technological displacement in terms of the workforce and employment?
We began hearing very early in the recovery period that companies were looking at ways to use technology really more aggressively in their business models. And a lot of the people who lost their jobs during the pandemic, of course, were people in service industries, relatively low-paid, public, customer-facing businesses, hotels, travel, entertainment, things like that. So I think we're going to see that, and that's, by the way, the technology coming into these industries has been a trend. I think we're going to see that accelerated, and you'll see more technology and maybe fewer people. And I think the implication of that is that we need to work as a society to make sure that people find their way back into the labor force, even if they can't find their way back into their old job.
And what I think that does is stress the need for improving human capital so that they can be competitive in jobs that they might otherwise not be. That's education. That's a lot of the things that, and I know you don't comment on fiscal affairs, but a lot of the aspects of the president's American Family Plan, preschool education, 2 years post-secondary education, significant job training, et cetera. But just in terms of the future, we're going to have to make those investments. Otherwise, my sense would be we're going to have a lot of people who want to work, but whose skills are not up to the new technological opportunities. Is that fair?
It may well be, and that's been a long-run trend. If people can keep up with evolving technology, that lifts all incomes and lifts their incomes, and if they can't, they tend to fall behind.
Let me change subject slightly here. Labor force participation. One of the other illustrations from the pandemic was that many, particularly women, were unable to continue in the workforce because of their child care responsibilities. Have you and the Fed looked at this factor as one of those inhibiting issues for labor force participation? And is it a factor?
It is a factor. If you include broadly caretaking, it's a big factor. Yep. If you just include children and schools being closed and caretaking at home and that kind of thing, it's still a medium-sized factor that's holding back participation.
So if there is reasonable and available daycare, that should contribute to increased labor force participation.
So I think it's daycare coming back, reopening, being available. It's also schools reopening in the fall, which should help as well.
Right. We've all, I think all of us touched one way or the other on the inflation issues, and some of these seem to be sort of one-off effects of the pandemic. Lumber went out of sight because people were sitting home, decided they redecorate and renovate. Lumber futures are down now, I believe, so we can see that leveling off, hopefully, in the future of prices. There was a chip shortage, which caused new cars to be expensive, which drove up the price of used cars. My sense is, your view is that these are transitory effects that are somewhat related to the pandemic or other causes but they don't represent a trend. Is that fair?
Yes, we can identify a half dozen things just like that, and they look very much like temporary factors that will abate over time. What we don't know is, are there other things coming along to replace them? We do hear of pressures across the economy. We don't really see prices moving up broadly across the economy at this point, but we're watching carefully for that.
And just a final point, in echoing something Senator Ossoff said, climate change every day becomes much more pronounced and much more obvious to all of us. And the impact on the economy is something that I think is not transitory. It will be with us. Simple things like food, when there's no water for irrigation, more complicated things like displacement of homes because of rising waters at war, or a lack of water rather. And I'm pleased to see that you're beginning to focus in on that. My sense is, though, every day there'll be another challenge, and it'll be more. The news will be more upsetting. Let me put it that way. I hope that's a fair comment. Thank you, Mr. Chairman.
Thank you, Senator Reid. Thank you for presiding. Senator Warnock from Georgia is recognized for 5 minutes.
Thank you so much, Chairman Brown, and thank you, Chairman Powell. I'm a strong advocate for working families and successfully pushed, along with Senator Brown and Senator Booker, Senator Bennett and others, expansion of the vital child tax credit program in the American Rescue Plan. The expanded child tax credit essentially provides a tax cut for middle-class families, cutting childhood poverty nearly in half nationwide, and is generally available to most American families with children, including families with little to no income. Today is a great day because many of them will see that tax cut hit their bank accounts today, and I'm happy to see hardworking families across Georgia and across the country see the benefit of this to help with the rising costs of raising our children. In my home state of Georgia alone, more than 1.2 million families will receive these payments, providing much needed relief to over 2 million children across the state. In previous remarks, Chairman Powell, you stated that, quote, the widespread vaccinations, along with unprecedented fiscal policy actions, are providing strong support to the economic recovery. With families now beginning to receive their child tax credit payments today, how does direct financial support to families help sustain an ongoing economic recovery?
Well, of course, we try not to comment on fiscal policy measures, particularly such as the one you've mentioned, but I will just say generally in the recovery from the pandemic that fiscal policy really did step in strongly and support people in their time of need, and I think the record will show that.
Thank you. I have another quick question about a housing bill I'm currently working on, which I hope will be a bipartisan bill. One of the other challenges that I've worked hard to address is the widening racial wealth gap in our country. A wealth gap that has been further exacerbated during the pandemic. In particular, I've focused on the persistent disparities that exist in the undervaluation of Black and brown homeowners within our appraisal market, which, as we all know, is a key contributor to creating generational and middle-class wealth. Most people's wealth is in their homes. This is directly tied to the value of their homes and thus their ability to pass on wealth to their children. I'm glad to see the Biden administration, the Fed, and other federal banking and housing agencies taking action, as well as banks, credit unions, the appraisal industry, and other stakeholders leaning in collectively together to help solve this longstanding issue. Now it seems to me it's time for Congress to join the effort. Chairman Powell, do you agree that addressing racial disparities within the appraisal market can help our economy and help close the racial wealth gap?
Well, I do think that there's no place for racial discrimination in our banking sector, in our housing sector, certainly in the appraisal. And there's a big focus now on appraisals, as you point out. And, you know, we will use the authorities that we have in supervising institutions, enforcing CRA to you know, try to eliminate that kind of discrimination.
Do you think it will help close the racial wealth gap?
I think over time, I think a lot of the racial wealth gap is traceable to housing, as you point out. So that should be the outcome.
Thank you. In April, our colleagues on the House Financial Services Committee unanimously passed the Real Estate Valuation Fairness and Improvement Act on a bipartisan voice vote. Not only would this bill be a great step in improving appraisal practices and mitigating racial bias, it seems to me it would also help increase and diversify the appraiser pipeline and increase the number of trained appraisers in rural communities. And so I'm planning to introduce this legislation along with Senator Klobuchar and Chairman Brown here in the Senate. And I hope to do so with a few of my colleagues from across the aisle because I believe we can work together in a bipartisan manner to tackle this critical issue that impacts not only these homeowners, but impacts the economy as we close the racial gap. We all have a stake in that. One final question on a topic that I'm also very interested in. Chairman Powell, as you know, the Community Reinvestment Act addresses how banks must meet the credit and capital needs of the communities they serve. Back in May, I asked your colleague, Mr. Quarles, about the Fed's intention to issue a joint rule along with the OCC and FDIC. And he expressed that it was the Fed's objective to work with the OCC and the FDIC to issue a joint CRA rule that protects and strengthens our most vulnerable communities. Could you please provide us with an update on the status of this CRA rulemaking?
I'd be glad to. We are working through the process of reviewing a really quite extensive group of comments and now engaging with the OCC to go forward and try to sort through that and come out with appropriate changes to what we proposed. I can't speak exactly to the FDIC. I think they're considering whether to take part in this process. We, of course, would really like to get the three agencies together on a CRA proposal, and I'm very optimistic. There's a lot of work left to do, but I'm very optimistic that the work product will be a very good one.
Thank you so much.
Thank you, Senator Warnock. I understand the chair can't comment on the immense importance of child tax credit, but I can, and I thank Senator Warnock for bringing it up and thank him for his leadership, even in his first 6 months in the Senate, on an issue that's going to make a huge difference to 39 million families, 52 million children, 92% of children in my state will benefit from it. We don't quite have everybody getting checks today or direct deposits today, tomorrow, and Saturday. We encourage people to go to taxcredit.gov, that people that are eligible, and that's, as I said, 92% of the children in my state. So, Senator Warnock, thank you for your work on that. Chair Powell, thank you for being a witness today and providing testimony for senators who wish to submit questions for the record. Those questions are due 1 week from today. On Thursday, July 22nd, Chair Powell, if you would, you have 45 days to respond to any questions. Thank you again. With that, the hearing's adjourned.
Thank you.
Thank you, Jay.
You have been listening to Fed Chair Jay Powell testifying before the Senate in a second day of testimonies, answering many questions, including questions about inflation, stimulus, fiscal and monetary policy, and the role of the Fed. In terms of the market reaction, not a lot happening at the end of the day. You did see a sell-off over in Europe, which I can tell you about that in just a second. But here in the U.S., you still get banks hit really hard. You still have tech relatively outperforming and bond yields moving lower as well as the buying continues to come in. Stronger dollar on the foot of that. Guy, different story over in Europe. You did see a bit of a sell-off there. It seems like it was a bit murkier.
Yeah, there's a bunch of things going on over here that I think are worth spending a little bit of time on. Actually, I think the biggest kind of compare and contrast between Europe and the United States comes from the comments we saw a little bit earlier from Michael Saunders. The Bank of England seems to be accelerating its kind of view of when it may need to taper. It's starting to see inflation data, which I would argue is in some ways very similar to the data we're seeing in the United States. There was a keen emphasis, obviously, from the senators today on that inflation impulse, and certainly hints now, strong hints starting to emerge from the Bank of England that maybe we are going to see tapering being brought forward. The market is starting to price in rate hikes over here. So we're not there yet, and Powell's sticking to his line, but you do wonder if you get a few more prints of the kind of data we've seen recently, whether or not actually that line starts to come under increasing pressure.
I got to tell you, Guy, I never thought that we'd have senators turn into commodity experts, but like I could count on multiple hands how many times they talked about copper, lumber. It was like, yeah, they're talking my language, man.
Yeah. Which isn't something that Alex normally can say.
Very much something that I never say.
But maybe, but if you take a look at the lumber story, maybe you could argue by the time the senators have started talking about it, the story's over, because that certainly commodity has seen a significant decline in prices from its more elevated highs.
Which is exactly what Jay Powell was saying, that those are specific issues, that that's more of a transitory thing, which is why he's staying firm with that current inflation is high, but it's unique, and that it is still going to be somewhat transitory. I want to get more reaction here, particularly what traders are looking for. Bloomberg's Vince Signorella, former FX and rates trader, also the voice of Bloomberg Audio Squawk, joins me now. Vincent, anything stood out to you?
Well, you know, what we're seeing and what I'm talking about with traders is you mentioned the transients, you mentioned lumber prices falling, and they've fallen dramatically. We've also seen a drop in food prices, a drop in energy prices, if we look at gasoline prices. And now we're starting to see a drop in used vehicles, which is something the Fed's been leaning heavily on as one of the reasons why prices have gone up, and they expect them to come down again. The problem is core CPI and core PCE have surged. CPI is at a 30-year high on a year-over-year basis, and PCI is surging also. I would argue the Fed, looking at transient prices, is saying, yes, they're coming off, and that's why we're holding the line. But core prices, which is what they usually measure, what they always look at, is sticky, and it's staying. And if that continues, their argument about transient prices falling is moot, because what they really need to watch for are the metric they've always watched for, and that may bring them to the table in tapering a lot faster and a lot sooner.
The other thing that we should probably sort of mention at this point as well, to your point, Vince, is the PPI data, which is also fairly hot at the moment, which would seem to imply that there is a degree of stickiness coming out of factories in terms of the inflation that they are delivering, that the stuff we're all buying is actually going up pretty fast, and it's continuing to go up. It's not a one-time step change. I'm really fascinated to see what ultimately we get out of some of the investment calls as we work our way through the earnings season, because I think we've already heard this from PepsiCo, others are talking about it. There is definitely a shortage of key workers, there's a shortage of stuff, trucks, etc. And I'm wondering at what point you think the Fed is going to have to start recognizing this. I wonder whether actually we are starting to witness it already. I appreciate that he's sticking to the transient line, that this is going to be a temporary phenomenon. But I'm listening to all the others around him, and I'm just starting to detect cracks maybe in what Powell is saying as well.
Yeah, no, I think you make a really, really good point. It's producer prices here and it's producer prices abroad that have been climbing drastically. The side of the equation you're talking about is really interesting, because when we saw CPI data, we saw a really big drop, and we have been seeing a big drop in real average weekly and hourly earnings, and that's because that's adjusted for inflation. Now, when the stimulus ends, the extra employments, the forbearance for rents, for mortgages, et cetera, when that ends, one would expect workers are going to try to demand more money because they've lost their support structure. If they do, then you're going to see the pressure that you're talking about on earnings, because companies that can will raise prices, but companies that cannot are going to really take a big hit. Now, the question is, what kind of power do consumers have in demanding more wages? I think on the lower end, they have a substantial amount of power to demand more wages. On the upper end, probably not so much. We'll see that at probably going into the end of the third quarter. It's going to be interesting how that plays out, because if wage demand or wage growth doesn't pick up and prices pick up, disposable income drops, and we're not going to see the pickup in the economic growth going into the fourth quarter that everybody's predicting.
Hey, Vincent, when you talk to traders, where is the policy mistake? Is the policy mistake in what the bond market is pricing, hike sooner rather than later, and then sort of tamping down growth, getting back to that pre-pandemic growth level of Or is the policy mistake the inflation running hot scenario getting out of control, having to hike fast later?
I think both of those, and I think it's also in the FX space. The fixed income space has been very complacent about this because they're buying this transient argument. I think they're missing the boat by not looking at the core argument. And the same is true for, I think, the FX side. A lot of people are expecting the dollar to fall because they're seeing the Fed staying lower for longer. But I think they're missing this argument in the core inflation rate that if the Fed needs to move more quickly, the dollar is well underpriced, as is the situation where, treasuries may be overpriced. And I think that risk is out there, and I think it's more of a third quarter going into the fourth quarter trade. But it's something I think a lot of traders are.
Ma Baoli, better known as Gang La, is one of the 4 Grand Marshals leading New York's Pride Parade this year. But in the country he comes from, being gay is still a social taboo. The CEO of a Beijing-based internet company is on a mission to improve the lives of millions of gay men in China.
对于每一个 LGBT 人群来说，即使这个国家不允许你跟同性爱人结婚，但是你仍然要勇敢地去选择你自己的生活，你仍然应该拥有幸福生活的权利。
Ma's company Blue City runs an app and a website specifically for gay men. Blued is one of the biggest gay social networking apps in the world, with an estimated 5 million registered users. Unlike most other apps, Blued is more than just dating or hookups.
大家可以在我们这个软件里面找他自己的情感，然后可以阅读相关的内容，然后可以进行一些娱乐，比如玩游戏啊，比如看直播啊等等。
Back in 2000, when Ma studied at a police school in northern China, he realized he didn't feel like everyone else.
因为他们都找女朋友然后谈恋爱，但是我对长得好看的同性的男生，我反而觉得对我更有吸引力。所以那个时候我就到互联网上去找这样的一些资料，然后希望能够告诉我自己我到底是谁。互联网上所有的信息都是负面的，都是错的，就是说同性恋要电击疗法，要被治疗，然后要吃药等等。
After visiting some foreign websites with different attitudes to homosexuality, Ma created his own site for a Chinese audience, encouraging people that
他们也是正常的，他们不用自卑，然后也不用自杀。
even though attitudes towards homosexuals are slowly changing in China, it's still a social stigma. The virtual world of Blood, where members can be open about their sexuality, is for most a striking contrast to their real lives. This is live streaming, a function added to Blood in late 2015, right as the internet craze was starting to take off in China. Many self-made stars like Jin make decent amounts of money by receiving audiences virtual currencies and gifts.
我们不是彼此的初恋，初恋这种事儿多不靠谱啊。
For Kyle and Klaus, a couple who have come out, live streaming on Blood means something different.
其实我经常会收到很多粉丝的一些互动的留言，就是类似就是说你们让我们看到了同志情侣之间的一些希望啊，我看到这样的留言我是很欣慰。
The government's rules for acceptable content online may shift quickly in China, with LGBT material in a grey area. Many companies feel the chill of the recent internet crackdown, but Blue City still runs as usual. Ma has won the Chinese government's trust by helping with HIV prevention among gay men. A third of the company's staff are dedicated to screening pornographic and politically sensitive content.
我不太多的愿意去对抗，我更多的愿意去对话，去改变他们的想法。我觉得这个可能在中国来说是更有效的。
In the past 5 years, Blue City has grown from a team of 7 people to a promising business with about 250 staff. Ma said the company earned over $15 million last year, mainly through advertising and selling virtual currencies to live streaming audiences. Now the company is expanding overseas.
我希望吧，通过我们的努力，布鲁蒂能够成为全球第一家在美国纳斯达克或者是纽交所上市的这样的同质互联网公司。
This is Rich Chiga. He's a Chinese rapper by way of Indonesia, and he's very popular on the internet. This is Joji. He's a Japanese-Australian singer, and he's also very popular on the internet. Plus, Joji invented the Harlem Shake meme. Let me say that again. This guy, Joji, in the blood bathtub, invented the Harlem Shake meme. But we'll come back to that. So Rich and Joji are both signed to 88 Rising, an entertainment company hoping to build a lasting global brand that will outlive singular moments of virality. They primarily create content combining Asian culture and hip-hop, a formula that apparently pleases the internet gods greatly. They've only been around for 18 months, but they're already putting up major label numbers.
I think that we have an unprecedented collective of talent, a group of predominantly Asian artists, really making waves globally, which from an independent point of view as well.
88's founder, Sean Miyashiro, cut his teeth launching Vice's electronic music channel, Thump. But quickly, Sean became interested in life beyond dance music.
I knew that after launching a whole content platform that I have kind of the ability and the know-how to do it again, but for what was the question?
So Sean moved to the Bronx to start over and figure it out. He couldn't afford an office space, so he worked out of his car at the top of a grimy parking garage.
Everything kind of started here. If you look around, this is my environment. This is my serenity, really. 88 Rising was built here. Built on the grounds of LA Fitness residence in a parking garage. I was living in the Bronx. I'm just damn, where the hell do I go? So I just come up here and I I just kind of figure things out every single day. Being okay, what the hell is this thing? Coming here was kind of my own kind of private office, basically. To be honest, I would even go to the bathroom here. I would take pisses here, you know what I mean? It was, it's just too far to go back down there. When I need Wi-Fi, I'd spend a good part of the day at Dunkin' Donuts. Hi, how are you? Can I get a chicken snack wrap?
Before 88 Rising officially launched, Sean caught a surprise break in the form of a Twitter friendship with a funny 16-year-old kid from Indonesia named Brian, who taught himself English by watching Rubik's Cube tutorial videos on YouTube. Seriously, that's true.
I thought his Twitter was genius, from the future, just crazy. And just the shit that he was saying, the memes he was making. But I didn't know that he rapped or anything like that. I really didn't. And he came up with that stick 2 weeks later.
12 in the morning, pop shells for a living and baby gon' smell blood trail every minute, bro.
Dat Stick was Brian's first ever attempt at making a rap song, and it immediately went viral.
Everything was great about it. But the one thing that I noticed is the song was hard as hell. Just everything about it, man. Just it was menacing, bro.
Soon after the video dropped, Brian signed with 88 Rising.
I'll FaceTime with Rich. Sorry for calling you Rich Chiga on my phone, Rich. Brian, he gets super pissed off that he's saved in my phone as Rich Chiga. He's dude, am I not a human to you? What's good, bro?
What's good, brother?
How you doing?
Doing great. I did the sound check.
How was it?
It was tight.
So, Brian could definitely rap, but some viewers understandably took offense at a Chinese kid satirizing rap cliches and calling himself Rich Chiga. But if a group of well-known rappers saw the video and genuinely liked it, that could at least help validate Brian as a legit hip-hop artist. Plus, it could be really funny.
It was just kind of an idea that I just had on the spot. Everything that rappers say is better and funnier and smarter and wittier. It's just more entertaining. We just edit it as tight as possible, put it up, and it really worked.
12 in the morning, pop shows, living there.
Yo, this nigga got a pouch on and a Reebok pouch. This is the hardest nigga of all time.
You said when you come for a chigga like me. That was dope.
Like, it's just lit, and I think people will take it as a joke at first, but it's like if he ran with that and kept doing more videos like that, it's just lit.
You know, I'd never been to America before, and like all of a sudden, just like I see like all the rappers that I listen to just like reacting to my stuff, and I was like, what? How did this happen?
The reaction video also went viral and even led to a remix of Dat Stick featuring Wu-Tang's Ghostface.
I'll get on that track. You know what I'm saying? Yeah.
Really, on the remix?
Yeah. Oh, you know him?
And yeah, the remix went viral too. Brian has since acknowledged the misstep in his name and claims he may change it. But for the time being, he's still Rich Chigga to his fans. An ever-growing global audience, hungry for more releases from emerging talent around the world.
I didn't know that it was gonna be this impactful and this important to people, and I'm very thankful and blessed that it has. And every day now that I wake up, it's like it's just like a new mission every day.
A major part of that mission involves Joji. Remember the bloody bath guy? He's a former YouTube personality in the middle of a career transition.
The sound of this song, Will He, it's like a trap song that you can like slow dance to. Awkward prom shit, you know what I mean? I used to do crazy episodic internet videos. It was going well, and one day it was me and a few friends just in a room. We were casually chilling, and then someone plays the song, and it's brand new at the time. I happened to have a lot of costumes laying around, so I told the other guys, I was like, get in these costumes and let's just dance to it. Like, who cares? We were like, okay, let's just go crazy at the drop. So that video goes up. I go to sleep, and the next morning, everyone's doing it. Like, next morning. That taught me a lot about the internet, how people want to just be a part of something. And from that point on, something changed, and I was a little better at understanding demographics and people and, what they want to see and what they want to hear. I was friends with a couple other artists who were affiliated with 88, and then I also started to realize that 88 is the bridge between Western and Asian entertainment, and I really wanted to be a part of that.
Joji just released the In Tongues EP, his first project as a serious artist.
Joji's In Tongues record came out a couple weeks ago. It's #2 on Billboard on the R&B charts, which is crazy for, independent release, and he's like a brand new artist.
And the success is even more impressive, knowing he went from creating something like this
It's just Taco Bell. What could possibly go wrong?
to creating something like this. Tonight, Rich Chigga has a show in New York City. Tickets sold out in an hour.
I came here, I'm first online. I was here at 1. I was the third person online.
So why'd you get here so early?
Because I want to see Rich Chigga. I want to touch him.
What do you guys think of Joji?
Oh my God!
That's my dad, son. You guys copped the new EP or like?
Yeah. I woke up at 6 in the morning just to cop that shit. And then I listened to it, and that shit started making me cry.
This is actually kind of exciting. Every time, this never gets old. Like, you live online and social media, but like, there's nothing like just being with the people.
More often than not, viral success happens by accident. And then after an appearance on Ellen or Jimmy Kimmel, the creator's star power fizzles out. But Idiot Rising has figured out how to turn potential gimmicks into brands with an actual following that keeps coming back for the next thing.
Oh, shit!
So keep an eye out for Idiot's next move. But more than likely, it won't be covered on network television or terrestrial radio. Although, as they've already proven, nowadays that really doesn't matter.
Online retailer Farfetch is betting it can shape the future. This is its concept store, showcasing the latest in retail tech.
How do you capture all of that fantastic information that you gather in store with customers, touch and feel products? And we created a concept called the Connected Rail. And this is using a combination of RFID and ultrasound. The RFID signal recognizes the product, and the ultrasound recognizes the movement. Take the product off, and then you'll start to see your products appear. And essentially, it's like online browsing behavior. Whichever products you touch and pick up in the store are automatically sent to your app. This is effectively what you've created is your in-store wish list. In the middle, you'll see essentially a hologram of the product. What the customer sees, they control the experience on a touch device. What this allows the customer to do is take elements of products and then add their own style to it. Right, so this is the connected mirror. So in this example, I see my products. I select a coat, and that's tried it, and it's slightly too big for me. So what I can do is choose an alternative size and send a request to the sales associate, and they'll bring that size to me in the fitting room mirror. You'll also see that we've got some product recommendations here. Crucially, the sales associate's able to push items into the mirror from their device. If you wanted to, you could simply use the mirror and pay and go. Your items would then be packed and dispatched to you afterwards.
Do you want me to turn you so you're looking outwards? Yes, please. How about there? First time we came out with B, Jade said, "It feels like I've been released from prison." Do you want these, Mrs.?
Definitely.
Definitely. Right. Yeah. And she could say hello to everybody, people she hadn't seen for months.
It's
Hi, it's
Jade.
Jade.
Oh.
So you can talk to Jade through this. Hi, Katie. She's there.
Hi.
Every time anyone's seen her, they want to know why she's there. And it's kind of the opposite of when you're in a wheelchair and people see you and they kind of go, oh, should I look? I don't know what the right protocol is. When there's a tiny robot with its bright little eyes going around just looking happy everywhere, it really opens you up for conversation.
You've got some friends here, look.
Hiya. When I saw her for the first time, I remember thinking, this is going to change things. This is one of those points where if this was a book, this would be the cliffhanger. condition called Ehlers-Danlos syndrome, which means that I have a lot of dislocations, there's a lot of pain, and a lot of seizures and whatnot. So I can end up on my own in my room for long periods of time. A lot of the time, with a condition like my own, of course there's the pain, and the pain is bad, and the dislocations are bad, and the seizures and being in paralysis and never knowing whether you're going to be able to wake up properly tomorrow, that's bad. But what's worse still is being able to count the number of people you see a day on one hand.
Are you ready?
Sure am, I'm just hoping the connection's going to stay.
Yeah, me too. Alright, here we go.
When you're used to just the same little metre by metre and a half window every day, and you've been there for months, being able to just see the sky from somewhere else, or the tops of trees, or a sign, is incredible. Or being able to have that kind of chat in the car that most people would probably take for granted.
I'm going to go past Grandma and Grandad so you can give them a wave. Now, if Jade is particularly seizure-y, she can still take part. And that's brilliant, really, because before she would just be left in a bed or in the house with just her carers. It's quite a small world, that.
Right, so there's one of them. Here, this costume I'm busy making at the moment. When I'm not on bed rest and I'm not just wearing pyjamas all the time, I enjoy being able to dress as different characters and go to Comic Cons and that kind of thing, because it just lets me show a different side of myself, and it's a bit of fun. If you can't go out that often, you've got to enjoy it when you do. Was that? Good. It's one of those weird things where I want to not have to use B because I want to be well enough to be able to go to those places myself. Like, it really makes a big difference to me to be able to go into school. But the thing is, with my condition fluctuating all of the time, I can't go into school reliably. Today's the first day that I've been in school via B, and so far it's interesting. Still a few little things that we need to work out, but for the most part I think it's going fairly well. And it's brilliant because I can really tell the difference between today and yesterday. How yesterday I forced myself to go into school when I wasn't very well, and I was really tired afterwards and ended up having loads of seizures, whereas today I've been able to do all of the work. I've been able to keep a clear head and not be ill, which means I'm able to be more focused on my schoolwork.
So there is my first step of working, is to simplify root 8. The algebra test is next week.
Now I'm trying to make friendships which I'll be able to maintain with B. Before that, I end up letting people down quite often. B gives me hope, yeah. She's just always there, and if I can't do something, she can. And if I need sort of assistance to be able to make commitments, then she's there, and she means that I feel like a more valuable person because I'm more reliable.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
The cubicle represents a tyranny, that it confines your imagination, your thoughts, into a small physical area. Imagine pretty much every software engineer or finance person being able to, disconnect from their desk and look at holographic monitors on a beach and doing their work from there. That's not going to be science fiction. It's the modern office place.
Silicon Valley is all about building the future. A startup called Meta thinks it's getting there first, thanks to a big bet that it's made on augmented reality.
How are you?
Good, thank you. Welcome to Meta.
Thank you.
Call it a 360-degree office where you can spatialize your thoughts as part of your workflow for education, architecture, design, engineering, etc.
People often mix up augmented reality with virtual reality. VR totally blocks your ability to see or hear the real world. AR overlays holograms onto what you already see. Meta has tried to make its version of the workspace feel familiar.
You grab the hologram instead of using a controller or a mouse, and your brain already knows how to do it. In other words, we've designed an operating system that humanity has always known how to use. So you can see this eyeball, which is, by the way, photorealistic. You can see my hand is occluding the eyeball, and now the eyeball is occluding my hand, right? You see those two circles? They get small, and then they turn into this glowing white ball, and then I can move my hand around supernaturally. I can do this with two hands and rotate the thing. I can stretch it. I can throw it back right into the shelving system, and that's all you have to learn to become a modern worker.
And to prove this, the employees at Meta have started to get rid of their computer monitors, trading them in for Meta's augmented reality headsets. Myron thinks that in less than a decade, we'll all be just wearing strips of glass that can project.
In the early 80s, everybody had computers on their desktop, but no one was using them because they had a lot of work to do. So they were still using typewriters. And at some point, the CEO took all the typewriters away and everybody was forced to use their computers. So it's very exciting to see a new generation of technology, a new paradigm.
I consider us like pioneers in the holographic wild. I'm pulling up my browser with my hands and sending out emails to colleagues and just kind of really acclimating to the new environment.
Now you're putting on my computer, essentially. Our digital lives live on our phones. We have all of our pictures and notes and all these kinds of things. So, and why don't you write yourself a little sticky note? I like it. And go ahead and just take your fist right over the top of the sticky note and close your fist. And now...
Oh, what? Meta's own transition to augmented reality has run into plenty of unexpected problems. And it's still going to be a while before you'll start to see these devices in your office. But I think it's a future worth waiting for.
If we could see these holograms between us, we will have been able to share our work with one another more naturally, more efficiently, and more productively than ever before. Humanity will have evolved slightly.
This is Hatsune Miku, Japan's sensational virtual pop star. She's released over 100,000 songs in multiple languages and performed sold-out concerts around the world. Her image has appeared in games, on TV, in car races, and is even etched on the side of a Japanese space rocket.
I came for Hatsune Miku, Carlos.
She's Lady Gaga's favorite digital pop star and opened shows for her in the US 3 years ago. Tens of thousands of fans attended her exhibition and live shows near Tokyo recently.
理想のアイドルっていうとどの曲でもミクはすごい綺麗に歌ってくれる。
他没有缺点啊，没有任何让我们感到不开心的一些新闻。
She's everything to everybody. That's probably why she's so popular.
Miku's creator Hiroyuki Ito and his Sapporo-based company have been developing the virtual diva for over 10 years.
初音ミクとはキャラクターとしてすごくYouTube とかで検索するとたくさんの初音ミクが出てくるんですけども、元々の初音ミクのその原点は歌声を合成するソフトウェアなんです。
Both the software and character are named Hatsune Miku, meaning the first sound of the future. Originally based on Yamaha's Vocaloid technology, Miku the software has a sound bank containing voice samples and a huge array of tools. You input the melody and lyrics, then Miku the character sings them. To date, Krypton has sold 120,000 software licenses at $200 each to fans around the world who use it to create numerous songs and share them online. Some of the fan-created songs are chosen to be part of Miku's concerts, for which they're paid a royalty fee.
元々初音ミクっていうその存在自体がそのボトムアップって言いますか、中にはアマチュアクリエイターじゃなくて今もうすでにプロになって活躍している方もいらっしゃるんですけども。
The company also has other revenue streams. It makes money from merchandising, licensing deals, and concert ticket sales. According to the real-life musicians who perform with Hatsune Miku, the virtual pop star is interesting and surprising.
今年で3年ぐらい、ちょうど3年ぐらいやってきて、ライブも数十本、数百本やったので、そういうことが演奏によって起こせるためのそういう器みたいな感じになっています。初音ミクらしさって僕はあんまりない。初音ミクって何だってあり。
For Ito, Miku has the potential to change the way we think about music.
そういう新しいそのテクノロジーによって新しい音楽のあり方っていうものを模索していきたいと思っていました。
And for her fans, it goes even further.
初音ミクって魂がないので、だからみんな魂を作り上げるために存在する。
Now, there are a lot of fitness gadgets out there. In my quest to get fit, I tested 17 of them over the last few months. At least one personal trainer I know was a little bit skeptical.
Yeah, I've been watching these new technologies come to the market for almost as long as I've been a personal trainer. They're just tricks and tropes. They're not much different than the Bowflex machines or, to be honest, the original Jane Fonda workout video.
But some of these gadgets that are just coming to the market do so much more than what they used to do, just tracking your activities. Out of all of them, this chest strap was my favorite. It comes with a robot coach that points to the future, one where you might not need a human trainer at all. And it works like this. You wear the chest strap so that it can read your heart rate, and that connects to Move's free app that talks to you.
Welcome to Move Heart Rate Hit Outdoor Running. Let's get moving and warm up in zone 2.
Move's computerized coach tells you what to do at that exact moment, whether you're running outside or you're doing body weight exercises indoors.
Swing your arms faster to get your legs moving quicker. Let's crush this round.
And by reading your heart rate, she knows exactly how hard you're working. She keeps you honest.
Way to go, you are in the target zone. Keep pushing, you're almost at the end of the round. Don't give up.
I've been running for 7 years now, and my biggest problem is that I never push myself hard enough. I end up going on the same slow, comfortable 30-minute jog, but the Move HR Burn blasted me out of that rut. By the end of these half-hour exercises, I was drenched in sweat in a way that I never am when I work out alone. Training with a real person is great, whether that's your group instructor or your coach or your personal trainer. But humans, they're expensive. For the rest of us, this $60 gadget is all you need.
what does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire! It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft of the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
Expose everything you won't admit. And action. This entire video is based on a true story. When I do like motivational speeches or even tell myself like love yourself and you should love yourself.
This is Lily Singh.
But to fans all over the world, she's the YouTube star Superwoman.
What up, everyone? It's your girl, Superwoman. I know we can change the world for the better, one positive day at a time.
My parents now know what I do. They didn't know what I did for a long time in the beginning of my career. I was just making videos in my room. They had no idea.
Mom, Dad, have you seen my keys? I can't find them anywhere. Because you're always on phone.
Until someone called them, like a family member from another part of Canada, was like, Canada, is your daughter making videos? And the mom was like, I don't know, Lily, are you making videos?
Just making videos grew into an entire career. Today, Lily's YouTube channel has some 12 million subscribers, over 2 billion views, and guest stars like Michelle Obama, Dwayne "The Rock" Johnson, and Seth Rogen.
I think a lot of young girls are raised to believe that you're going to go to school and then graduate and then get married and then get a job and then have kids.
And Lily was on that path, all the way through a psychology degree at York University in Toronto. But when she started thinking about a career,
I started to immensely panic and think something was wrong with me because I tried to figure out my life and it wasn't working in that straight line.
It was 2010, and YouTube was only 5 years old.
I thought nothing of YouTube. I was probably the last person in my circle of friends to discover YouTube. And I remember when I did, I thought, this is so strange. There's people making videos in their rooms, and other people are watching them.
So she figured, why not give it a shot?
I one day posted a video because I was sad, and I wanted to be creative and happy.
She didn't know how to edit video or write scripts, so she winged it.
It was so bad and so cringe, and my expectation was literally nothing. I was like, I'm gonna put this video up, a couple of my friends are gonna watch it, probably make fun of me, and that's gonna be the end of this. The second and third video came from, wait, 70 people watched my first one, can I get 80 to watch the next one?
She kept creating, she kept posting, and the viewers kept coming. Lily had found an audience.
A lot of the comments were, oh my God, there's a brown girl on YouTube.
More specifically, Indian. Lily's parents immigrated to Canada from India, and Lily was born and raised in Scarborough, near Toronto.
My home life was awesome. My parents, even though I portrayed them to be quite strict in my videos.
Oh, Lily, wear the rest of your skirt, huh? I teach you like this, to walk around like this, showing everything to everyone?
They actually aren't like that at all. They're pretty modern and pretty cool.
Your dress is short. Don't know what for.
And were pretty lenient with me. I mean, I got away with a lot of things. I was a brat. I was a brat.
She had a different idea of what she wanted out of life than other kids. In a grade school graduation slideshow, her classmates said they wanted to be lawyers and doctors.
And then I came up and I was like, rapper.
Making out with your friends, man. But then you say that you hate hoes.
I could just feel my parents being like, why?
Because that's just not something women really did in the Singh family.
I know there was a ton of people that weren't happy about my birth being a female, so I think, and that's some real-ish, but it's a real thing. The best thing I could have done to prove to so many people that didn't want my mom to have a daughter was to become Superwoman.
What up, everyone? It's your girl, Superwoman.
It was the name of Lily's favorite hip-hop song by Lil Mo featuring Fabulous.
I love the song so much because it was one of the only songs at the time that was an empowering female song, where Lil Mo's going on about, like, I will save guys with my superpowers, and I will save girls with my superpowers, and I am Superwoman. I thought, this name that I've had for so long that empowered me when I was younger, I'm gonna make this my screen name. Maybe this should be a new series.
Superwoman didn't just burst onto the scene overnight with a viral video. It was a steady climb fueled by hard work.
The moment that I thought this is going somewhere and this could be a career was the first time I performed internationally. It was in India. And it was the first time where I was truly across the world and people knew my videos.
Singh has transformed herself from a bratty kid to an internet personality to a media mogul. She starred in a feature film, A Trip to Unicorn Island, in 2016. And her book, How to Be a Boss, hit the New York Times bestseller list in 2017 while she was on a 30-city international tour. Lily started out with the goal of getting millions of subscribers and financial security.
Hurry the hell up.
But after surpassing those goals, success has new meaning.
I've really come to terms with the fact that my definition of success is what's the best legacy I can leave behind. And it's not the number of views and the number of subscribers. It is the number of people that can say, this girl changed my life or changed something in my life positively.
CTE is often found in the brains of deceased athletes, military veterans, and others with a history of repetitive brain trauma. Hundreds have donated their brains to the VA Boston University Concussion Legacy Foundation Brain Bank.
This is a former NFL player who died in his early 70s, and this is a veteran who also died in his early 70s.
Dr. Ann McKee dissects these brains.
The hippocampus and the mammillary bodies are very important for memory. I can see that they're slightly affected.
McKee recently dissected the brain of former New England Patriots player Aaron Hernandez, who was convicted of murder and later committed suicide.
You'll see right away that the brain is showing signs of shrinkage. You can see the crevices in the brain that you can't see in the normal.
McKee says Hernandez's severe case of CTE impacted his decision-making, depression, and ability to control rage and aggression. Right now, she thinks we're underestimating how many people have CTE.
We were able to distinguish between CTE and controls and CTE and Alzheimer's disease. The next question is, can we do this in the blood, and can we do this in living people? And we aren't there yet with those answers.
But the need for a diagnosis in the living is motivating companies such as Quanterix in Lexington, Massachusetts, to work faster on technology that could diagnose concussions and CTE in as few as 30 minutes. Kevin Rosovsky is the CEO.
It's like a high-powered microscope. And so by doing that, we can see little biomarkers that you couldn't see before in the blood.
Quanterix received a grant from the NFL and just went public. Since then, its stock is up more than 40%. The company sells a machine called Simoa for $175,000 to other biotechs, hospitals, and researchers.
And for the first time in history, we're able to see brain health in blood, and that's a major breakthrough, and that's leading to less invasive testing, and we've already been able to see evidence of concussions, and there's the beginning evidence of being able to see the accumulated effect of concussions.
Quanterix is also trying to detect Alzheimer's disease, multiple sclerosis, and ALS. Rosovsky says he thinks diagnosing concussions will be easier than diagnosing CTE.
Diagnosing CT in the living probably is a couple years away. We're real excited to see the progress, but reducing some of that work into actual tests in the laboratory takes time. There's regulatory approvals. There's a lot of red tape that you have to go through.
Also in this race to diagnose CTE in the blood are Athlon Medical and Exosome Sciences. And New York's Mount Sinai Hospital is scanning for the disease in the living. But it's just one step in a series of questions for those with serious head trauma. There's still no cure for CTE.
Even if we had a great idea for a treatment, there's no way to test whether it's effective or not. So that's the enormous advance that we'll get if we can develop a biomarker for this disease.
In Boston, Ann Mostu, Bloomberg News.
Wine is a $300 billion global industry where one person's opinion can make fortunes or break them. That's because of this man, Robert Parker, and his newsletter, The Wine Advocate. For 3 decades, he dominated as the world's most influential wine critic. Now Parker's protege is building an empire of his own. Antonio Galloni runs Venice.
Antonio, tell me, what are you trying to build at Venice?
Well, at Venice, we started with the idea in 2013 of building a world-class platform. We have a database of about 250,000 professionally written reviews. On Delectable, we have 7 million user reviews. Through Delectable, we also have a partnership with Whole Foods and several other partnerships that we can't announce just yet. And when you put that all together, what we have is something that no other company in our space can even come close to.
Do you think of yourself as the next Parker?
Not at all.
Why?
Because Steve Jobs said you can't live your life trying to be somebody else. So he's one of my biggest influences, and I've never wanted to be a replica of somebody else because a replica is never as good as the original. Bob is a genius, fantastic, one of a kind. We're going to be something completely different, and I have no desire to be some version of somebody else.
Different in what way?
Every decision that I've made at this company is completely anathemic to what Bob did with his company. I want our writers to be partners. All of my senior people are locked into the company. They all have equity or they have a path to equity based on business results. That's something that we never had at Parker. Our benefits are world-class, and everything that we've done at Venice is completely different from that model. When Steve Tanzer, who is the most experienced active wine critic in America, wants to work with us, that says something. When Alessandro Masnaghetti, who's the best cartographer of vineyards, wants to work with us, that says something. When Neil Martin, who's a superstar wine critic with enormous experience in Bordeaux and Burgundy and the former lead critic at The Advocate, wants to come and be part of our team, that says something.
You make it sound like The Wine Advocate was a disaster as a company and a miserable experience as an employee.
No, it was great because I got to work with Bob Parker when he was at his prime, you know, and Bob was like a second father to me, and we talked on the phone all the time, and he gave me great advice.
Can anyone's palate dominate the wine criticism business the way Parker's did? And should anyone's palate dominate it the way his did?
I just think the world is very different today. You know, it's just a totally different world. It's probably not healthy to have a single person dominating the world.
It's not even wine criticism, it's the wine industry.
Yeah, that's probably not the healthiest thing in the world. But I think that there's just such an opportunity right now with social media and technology to reach such a massive number of people that I think it's possible that 1 or 2 people will actually have more influence than Bob Parker did, because they will, again, this goes back to your first question, not trying to be a version of somebody else. You see this in sports all the time. It's like, oh, well, nobody will ever beat this record. And then somebody comes along, you know, it's like tennis, Pete Sampras. Nobody's ever going to win as many Grand Slams. Now you have 2 guys who are ahead of that and 1 knocking on the door. And so I think a lot like that.
You're a former investment banker. How does that inform and influence what you're doing and what you've done?
My generation has had to deal with a lot more challenges. That's why I think we're actually much better poised for the future. My first job in finance, the first thing that happened was long-term capital, 1998. Then the tech bubble melted down. Then there was a mutual fund trading scandal. You know, that was all like within about 5 or 6 years. And these are the things that I had to deal with as a young executive. My peers who were 20 years older didn't know how to manage in crisis. They'd only seen Black Monday. They'd just been in a big bull market. It's very different. So I'm very lucky. People of my generation or a little bit younger have actually had to deal with a lot more crises. I think that's actually good for learning how to cope with challenges in business.
From the outside, it kind of looks like you're trying to demolish the house that Parker built, right? You left The Wine Advocate.
Yeah.
You merged with one of his chief rivals.
Yeah.
And you just hired his successor, Neil Martin.
Mm-hmm.
So are you?
I think what that says is that all the best people want to work at our company. And that's really what we strive to create starting in 2013. We wanted to create a world-class company that would attract the best-in-class talent, and not just on the content side, on the technology side, on the digital side, our office, and at every level, what we're trying to, we only hire superstars, and we're looking for those superstars.
In the world of professional wrestling, there's something called a swerve.
Hulk Hogan has betrayed WCW!
Some examples. These tag team partners are called babyfaces, or the good guys. Then one of them swerves when he super kicks his tag team partner in the head, quickly assuming the role of the bad guy, or what the wrestling world calls the heel.
Are you kidding? What a despicable act that was!
Or a match is almost lost when, what's that? The superstar wrestler appears out of nowhere sprinting down the aisle to save the match.
That's the Warriors music! It's the Ultimate Warrior!
That's a swerve. So it should go as no surprise that World Wrestling Entertainment, known as the WWE, the most popular brand of sports entertainment in the world, is prepared for any swerves that come their way. So here's the story of how the WWE learned to see the swerve coming. So I spoke to Bloomberg reporters Felix Gillette.
I'm a writer for Bloomberg News for the global business team.
And Kim Basine.
And I'm the U.S. luxury reporter at Bloomberg.
To find out exactly how the WWE is positioning itself for an all-out global invasion, which starts with a massive change to their lucrative pay-per-view model.
WWE basically pioneered the pay-per-view model on cable. I remember as a kid, when the pay-per-view events came up, all of our friends would scramble around and try and get one of the parents to pay for it.
But in 2014, they took a huge risk.
They saw a little bit sooner than some of the other entertainment brands that where this whole thing was moving was away from cable and satellite television and towards on-demand streaming video apps. They made this risky decision, in essence, cannibalizing that pay-per-view model, which they had essentially built.
And after some early turbulence, it's working. Roughly 1.5 million people are paying $9.99 a month for the WWE app, making it the 5th most popular streaming OTT service. This adapt-or-die approach is in the WWE's DNA. Over the past 30 years, the company always seems to think 2 steps ahead. In the early 90s,
WWE was at its most threatened when Ted Turner took them on with WCW,
which stands for World Championship Wrestling. And back then, the WCW was winning the ratings war. So in order to compete with them,
WWE had changed its product from a family-friendly kind of cartoonish style to this really raw. That's why they called their show Raw. It was this raw style of wrestling.
With violent, outrageous, reality-inspired plot lines and aggressive personas.
From a 16-foot ladder!
And they won that fight against Ted Turner. And they bought WCW.
The early 2000s ushered in an era of testosterone-driven programming aimed at the red-blooded American male.
Bra and panties matches, and people smash each other over their head with like barbed wire bats and things like that.
Until 2015, when WWE fans started a hashtag Give Divas a Chance. Since then, WWE has hired 40 more female wrestlers, and that growing cast of female characters was part of a much larger plan.
They started to try to appeal to a broader set of people.
Let's attract more female fans. And after we've attracted more female fans, let's attract more international fans. They're broadening their base, and they're doing that in large part to make it more advertising friendly.
And not just friendly to advertisers.
They're trying to build up their fan base in China. They're trying to build up their fan base in Europe. They, already have a pretty good fan base in India.
India is a place where they already have an established wrestling culture.
Because of the gigantic Indian wrestler, the Great Khali. But there's still a lot of work to do. While the WWE set a revenue record in 2017, only 30% of it is coming from an overseas audience. And there's one person whose responsibility is to grow that number.
The buck eventually stops at Vince McMahon, no matter what's happening within WWE.
Yeah, he's a very controlling guy, and it's a very, very, very tightly scripted company.
And that goes all the way down the board to big stars' entrance music. And their outfits and things like that.
So with a CEO like McMahon always planning 2 moves ahead and an aggressive push into multiple international markets, a big issue is money.
It's hard to do all those things simultaneously without committing a huge amount of capital to it.
And that's where the WWE becomes an attractive company for buyers.
Potentially, one thing that could happen with WWE is they could benefit by being acquired by a bigger technology or telecom company, an Amazon or Facebook or or a 21st Century Fox.
So with a market cap of $2.8 billion, the advantage of owning 100% of their own content, and a rapid consolidation spreading throughout the entertainment industry, it looks like the WWE is well positioned, even if there are swerves ahead.
Our world is changing. Every day, it changes a little faster. Some changes are too small to see. Others, too big to handle. Sometimes, change feels slow. So slow, we don't even notice. Other times, it happens all at once, and we can't keep up. For our climate, change means many things. And between too small to see and too big to handle, there is a whole world of difference. The clock is ticking. This is Bloomberg Green.
Saving the seas. This week, the deep-sea diver who stopped writing the ocean's obituary to find a solution. Enric Sala tells us why the next 10 years matter most. And globalization needs to get greener. Shipping accounts for nearly an eighth of all transport emissions. How can the industry clean up its act? Plus, protecting coastlines comes at a huge environmental cost. But one Israeli startup found a way to keep the sea out and the animals in. From London, I'm Anne-Marie Hordern, and this is Bloomberg Green. After more than a decade of studying the ocean as an academic, Enric Sala realized he was writing the ocean's obituary. He quit his job and became a full-time conservationist. As an in-house explorer for National Geographic, he's clocked more than 5,000 open water dives. He's also founded Pristine Seas, a project that combines exploration, research, and media to lobby countries to protect their oceans. To date, it has helped create marine reserves equivalent to half the size of Canada. I spoke to him about his mission and why it's so urgent.
The state of the world's oceans is really bad. We have lost 90% of the large fish in the ocean. Sharks, groupers, cod, tuna. More than half of the fish stocks are overfished, which means that we are taking them out of the water faster than they can reproduce. More than half of the ocean is affected by industrial fishing, and global warming is killing coral reefs all around the world. The ocean is in a trajectory of decline.
Can you just visualize for our viewers who never get to see the kind of things you are able to see, what an ocean and healthy ecosystem looks like versus one that's next to a bustling economic and industrialized area?
Coral reefs in the United States, in the Florida Keys, are down to only 2% of what they used to be. Before, 80 to 90% of the bottom on a coral reef in the Caribbean was covered by live coral. Now, Florida Keys have only 2%. The average in the Caribbean is about 5% of the bottom covered by live coral. The rest is covered by slime and seaweed. And most of the fish you can see are this big. And it is very, very rare that if you jump into any place in the Caribbean at random, you see a shark. It's very, very rare. Now, let's go to Millennium Atoll, for example. An atoll that is uninhabited and fished south of the equator in the Central Pacific, belongs to the Republic of Kiribati. 2009, we conducted the first underwater expedition to this island, and I still remember the first time. Jumped over the side of the boat, and as soon as the bubbles cleared, I was surrounded by 15 gray reef sharks. After a couple minutes, the sharks decided that we were boring, and they went back to do their thing. And you look down, 90% of the seafloor is covered by thriving coral, and it's full of fish, and a sea turtle comes by. Now, this abundance that we rarely see anywhere except in well-managed marine reserves. This is what the ocean used to be like, and this is what we have learned from going to these pristine places.
And you write in your book that you're writing the obituary of ocean life. What's the cure?
The cure is doing less harm. Basically, there are three things that we are doing to the ocean. One is we are taking fish out of the water faster than they can reproduce. Two, we are turning the ocean warmer and more acidic because of man-made climate change. And three, we are throwing in everything that we don't want, our waste and our plastic. We need basically to reverse these trends.
Does this mean that a lot of this falls to governments and their policies?
That's a big part of it, because it is governments that regulate fishing and mineral extraction and oil extraction. It it is governments that have the legal authority to create large marine reserves in the ocean. But also, local communities have an important role to play because some of the most successful protected areas in the ocean are community-led and community-managed marine reserves. So when the fish come back, the divers come in. And that creates huge economic opportunities through ecotourism. These areas that are managed by communities are very successful because the communities have a vested interest in having as many fish as possible inside them so they can enjoy the benefits.
What from the pandemic has changed your view when it comes to protection of the environment?
Nature has given us a very strong signal of how fast it can recover if we just give it space. Everybody was fascinated by all these videos of the whales and the dolphins coming into marinas and mountain lions on the streets of Santiago in Chile, wild goats in the UK. Nature has this extraordinary ability to bounce back if we just give it space. This is why we need to protect at least 30% of the planet by 2030.
How do healthy marine ecosystems help in the fight against climate change, though?
Most people see the ocean as a victim of climate change, but the ocean can also be a solution because we know that the more life that is in the ocean, like big fish and big whales, the more these organisms help to make the ocean productive and absorb more CO2. The kelp forest, seagrass beds, all of these are important ecosystems in the ocean that are similar to the forest on the land that capture a lot of our carbon pollutions.
What are you most excited about in your field?
We have 10 years to fix this problem. Global fisheries catch is going down, stocks are collapsing. Business as usual means that by 2050, 90% of the coral reefs are gone, that most commercial fisheries have collapsed. That affects food security, that affects migration of people. We have 10 years to get to peak greenhouse gas emissions and then go carbon neutral by 2050. And we have 10 years to protect at least 30% of the ocean so we can restore much of this health and productivity, not just for saving biodiversity, but also saving our life support system. We are not talking about something that is apart from us. We are not apart from nature. We are a part of nature. So these 10 years are probably the most critical in the history of humanity.
The most accurate measurements of changing oceans will come from space. While Enric Sala explores what lies beneath, a new satellite is giving us data from above.
We'll learn more about our oceans and climate change, but from space. A new satellite's been launched from California. Its mission: track the accelerating rise of sea levels.
Well, the main instruments on board include a dual-frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise.
Data gathered from Sentinel-6 will be used alongside information from other satellites to build as complete a picture of the oceans as possible.
With a long record, we can precisely measure the acceleration. We eventually can detect new regime, tipping points. For example, if there is a runaway in the melting of Greenland or Antarctica, sea level will record this runaway change because it is an integrator of all changes that are occurring in the climate system. So we will be able to see some change, big change in the global climate.
The National Oceanic and Atmospheric Administration expects that sea level rise will increasingly threaten U.S. coastlines. One example, the southern tip of Manhattan is expected to flood 20 to 40 times a year by 2030.
11 of the 15 largest megacities are located at the coast, and this number will double. The number of people living in coastal area will double by 2060. So, knowing how much sea level is rising at the coast and how much it will rise in the future in coastal areas is as obvious. It's obviously a major goal for human beings.
Coming up, from sails to steam to oil, the shipping industry is no stranger to change. But how will it navigate the next transition? This is Bloomberg Green. From Bloomberg's European headquarters in London, I'm Anne-Marie Hordern. This is Bloomberg Green. Now, for your roundup of this week's latest climate news, Jennifer Zabazaja has your Green in Brief.
Here's the climate news you need to know. Deforestation of the world's largest rainforest has hit a 12-year high. More than 4,000 square miles of the Amazon rainforest was destroyed in 2020. That's a 9.5% increase from a year earlier. Government data shows that destruction has soared since President Jair Bolsonaro took office and weakened environmental enforcement. The Amazon is home to millions of species and plants and is critical in the fight against climate change. Bitcoin is hitting all-time highs, but at what cost to the environment? The cryptocurrency is energy intensive, and there are concerns if it becomes mainstream. According to MIT, back in 2018, Bitcoin's carbon footprint was almost as big as Portugal's. Want to get better at tackling climate change? We'll hire more women. That's according to Bloomberg New Energy Finance. Firms with 30% or more women in top jobs tend to perform better when it comes to the environment and are more likely to set clear climate goals. Shopping online is more popular than ever now, but the price of convenience is measured in CO2, and more deliveries means more fuel burned and more packaging wasted. So what can companies do? Well, many are becoming more efficient and sourcing more clean energy for their data centers and warehouses. And England's farmers will be paid to go green after Brexit. As European subsidies are phased out, they'll get new money to encourage them to produce healthy, sustainable food. Poor farming practices are one of the leading drivers of water pollution and the loss of biodiversity. I'm Jennifer Zabazaja in New York. Anne-Marie, back to you.
The shipping industry is more than just the grease on the wheels of globalization. It's its chief enabler. 11 billion tons of goods are transported by ship each year, the biggest contributors being 2 billion tons of oil, 1 billion tons of iron ore, and 350 million tons of grain. According to the International Chamber of Shipping, 80% of Europe's imports and exports happen over the seas. And for such a vast industry, it also contributes its fair share of emissions. Shipping makes up 12% of global transport energy consumption. So how does it clean up its act? Earlier, I caught up with Bloomberg Green reporter Laura Milan about just how big of a challenge this is going to be for the industry.
One of the main issues is size. So about 90% of the world's cargo is moved by ships. So obviously changing such a huge industry is not going to be fast and it's not going to be easy. The second issue has to do with technology. So ships obviously travel for many days at sea. It's not as easy for them to refuel as it would be for a car, for example, going on a road. And the sector still hasn't found a technology that's economically viable and that's zero emissions, an equivalent to the electric batteries for cars, for example.
But actions are being put in place to make the industry a bit more environmentally friendly. Walk us through those steps that they're taking.
That's it. So there's a first step that would involve using low emission fuels or biofuels that would significantly reduce the existing emissions. And then at a regulatory level, when it comes to the policy and the governments, there are steps being made as well. I would say that the most significant ones come from the European Union, which started to track emissions a few years ago and is now looking to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
The concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube-sized concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, e-concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing e-concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism die, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, e-concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, streaming on YouTube, it is Friday's Eve. It is Thursday, July 15, 2021. Carol Masser along with Tim Stenovic. We got a lot going on. Worries about Chinese growth and Jay Powell's dovishness weighing on the trade today. And coming up, looking forward to this, Carnival launching another ship in about 2.5 hours from a U.S. port. We're going to talk with CEO Arnold Donald.
We're going to get an update on the business. We're going to see how demand is, what the company's doing about COVID. Very excited about that. Also, thriving in a world of digital giants, the $500 million, $500 billion ETF rush. Also, Carol, the Earth guitar.
You caught that. That was my typo. So
That's okay.
Forgive me, because it's billions.
It's billions.
Hundreds of billions of dollars.
And then guess where they're not going? Mutual funds.
Exactly. The world is shifting. All right, we've got lots to cover, including our conversation with Arnold Donald. Looking forward to that. First up, though, let's get you going on this Thursday with a check on that trading day. Hey, Charlie Pellet, also a fan, I know, of cruising.
I am. I can't wait to get back on a ship. And the question you got to ask is just how soon until they hope to have that full schedule back. Carnival Corp sailing lower right now, down 5%. That is true for the rest of the cruise line stocks that we follow. RCL, Royal Caribbean, lower now by 4.6%. NCLH, Norwegian Cruise Line Holdings, also tumbling now by 6.5%. Choppy waters for cruise stocks today. The Dow, the S&P, NASDAQ, they're all declining. We've got the S&P down 31 right now, down 0.7%. Pulling up the GIP function on the Bloomberg for the S&P 500 index. Yes, just about the low of the day. day. We've got the Dow down 77 now, lower by 0.2%. Also the low of the session. NASDAQ now tumbling 180, down 1.2%. Tech shares leading stocks lower. NASDAQ 100 index down 1.1%. 10-year yield 1.30%. 10 years up 13.30 seconds. Gold up 0.1%. 18.29 the ounce. West Texas Intermediate crude down 1.5%. 72.05 a barrel. Verb Technology shares surging. So-called meme stocks favored by retail investors on social media platforms continue a rally.